Hello all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great. So from today we are going to start with one of the most important session for you all, which is going to help you all to a great extent in your upcoming exams of May 2025 and November 2025. So we are going to start with the revision videos, comprehensive revision videos with great amount of interlinking in the subject of one provision with the another provision for May 2025 and November 2025 as per the latest Finance Act number 2, 2024. So this revision video will be from our colored easy notes, that is our concept book. I'll just show you the concept book first. So this is our concept book which covers the entire CA Final Direct Tax in a very comprehensive yet in a concise manner, so that on the day of examination you can revise it very easily. And you can take help of my revision videos also, which I will be uploading in complete English for you all, especially to my South Indian students who struggle understanding Hindi. So I generally upload both the lectures, that is in Hindi also and also in full English. So whatever language you are comfortable, you can watch in that language the revision videos that we are going to upload. Now this book is fully updated as per the latest Finance Act. It is relevant for your May and November 2025, and if you are giving CMA exams, then it is applicable for your June or December 2025. This is fully updated as per the latest Finance Act. It is available on our website also. We have used multiple colors over here. Different colors are used to signify different points. All the important points are highlighted in red color. All the amendments, latest amendments made by Finance Act 2024 are highlighted in green color. Case laws, Supreme Court, High Court judgments are highlighted in blue color, and the section numbers are highlighted in purple. And the main content is in what? Is in blue color, dark blue. This is the index which is there in front of you, and this is our first topic that we are going to revise today, which is the most important topic in your CA final syllabus, that is profits and gains from business and profession. Always remember, the first question in the exam of 14 marks is going to be on this chapter, that is on PGBP, profits and gains from business and profession. So let's start with the revision of this particular chapter without wasting any further time. Let's start. The provisions of profits and gains from business and profession are spread out from section 28 to section 44 DB. So these 17 section covers all the provisions of PGBP that we are going to revise in this particular chapter. The section 28, the first section of business and profession, talks about charging section. And in this section 28, there are two types of charging section. One is a general charging section, another is a special charging section. General charging section talks about certain conditions. If you fulfill those conditions, your income is covered under business and profession. Special charging section comes into picture when your case does not fall under the general charging section. If you do not get covered under the general charging section, you can go to the special charging section. So let's talk about the general charging section first of all, which is given under section 28 clause 1, which says that you have to earn profits and gains from business and profession, which is carried on by the assessee at any time during the previous year. And if your case does not fall in this, then there are some special charging sections which we are going to do after some time. Let's talk about the general charging section. Let's talk about what do I mean by the term business. What do I mean by the term profession? What do I mean by the term profits and gains? What do I mean by the term carried on by an assessee? And what do I mean by the term at any time during the previous year? See, what is business, what is not a business, it all depends upon facts and circumstance of every case, because the definition of business as per the income tax law is an inclusive definition. It is not an exhaustive definition. The government of India does not give us the meaning of what is business. They only give us what includes in the business. So what does business include? As per section 2 clause 13, business includes trade, commerce, manufacture in the nature of adventure. So whatever you do, there has to be an adventure. Adventure means there has to be some kind of risk in your activity. Otherwise, it cannot be called as a business. But again, I am saying what is business, what is not a business, it depends upon facts and circumstances of every case. This definition does not give us any substantial test. Substantial test is not given by the income tax department. You have to check the facts and circumstances of every case to determine what is business, what is not a business. Now let's come to the definition of profession. What is profession? Profession is a one-word definition. As per section 2 clause 36, profession includes vocation. Just one-word definition. Now what does vocation mean? Vocation in general terminology means any occupation requiring some skill. It can be called as a vocation. Now there are some examples which are put by the ICI in your study material. We need to identify whether this income will come under business and profession or it will go under some other head. Like Interest income. Whenever I ask somebody where will the interest income go, the first impression that will come to our mind is IFOs, income from other source, but that is not always true. Interest income can come under income from other source also. It can come under business and profession also. That depends upon in what capacity you have earned it. In this case, for example, to get a contract, you have given a bank guarantee, and for making that bank guarantee, you have made a fixed deposit in the bank. So you have done ultimately all these things to get a business contract. And therefore, earning of interest over here is not an objective. The objective is to get a business contract. Therefore, this interest income will be classified under what? Business and profession as per the Delhi High Court judgment of K&N Company. Similarly, there is an assessee in whose factory there is a lockout. Lockout because of any reason, because of strike by the employees, because of some shortage of raw material, because of say COVID. It can be anything in this world. Lockout can be because of many reasons. So because of the lockout, now the company is thinking that instead of wasting our resources, let's let out our plant and machinery and furniture for some months to some of them. Let's let out that and earn some income out of it. At least we will take out some money. We will make some money so that we can at least bear the wear and tear of the machineries and the plant and machinery and the furniture. So the company is doing what? The company is letting out the plant and machinery furniture during the lockout. Where will this go? So the court has held that this will go under the income from business and profession. Okay. It is the business expediency of the assessee. It is the business intelligence of the assessee that till the time the factory is under lockout, till the time the factory is not operating, we can use that factory resources for some other income to make out our expenses. Therefore, this is a business expediency and it will go under income from business and profession. Okay, as per the court judgment. Similarly, generally, if you let out a godown or a warehouse, where will it go? The first impression that will come to our mind is income from house property. But in this case, the assessee was not merely engaged in letting out. Assessee was giving lot of services along with letting out. Like assessee was giving several auxiliary services like pest control, rodent control, fumigation services. The assessee was also giving security and protection services. Therefore, the court held that this will go under business and profession and not under income from house property. So what goes under business and profession? What does not go under business and profession? It's a matter of great discussion. You have to look into the facts and circumstances of every case. These are some of the cases which are there in your study material, which is a part of your syllabus. So we are discussing it. But these are not the end of the world. There are many other cases practically which will explain you what comes in business and what does not come in business. Let's take another example. Generally, if you let out a property, where will it go? If generally I let out a property, it will go under income from house property. No doubt about it. But there is a Supreme Court judgment of Chennai Properties and Investment Limited and Supreme Court judgment of Rayala Corporation, which says that if there is a company, listen to the conditions very carefully. If there is a company, in the memorandum of association of the company, it is written that the main object of the company is to acquire property and let out, and the substantial income also come from there. If these conditions are fulfilled, then income will go under income from PGBP income from instead of income from house property. This will go under business and profession, even though generally let out of property goes under house property. But if you fulfill these conditions which I told you just now, which are written over here, then your income will go under income from business and profession and not under income from house property. But under this particular case law is slightly overridden, not completely overridden. It is slightly overridden by Finance Act 2024. Finance Act 2024 has made an amendment which says that if you let out a residential property, which property? Check here. If you let out a residential property, then close your eyes and go under income from house property. Then it will always come under income from house property. So Finance Act 2024 has said that if you let out a residential property, then don't even think about going under business and profession. It will always go under income from house property. Therefore, there are two opinions, there are 2 points which you have to keep it in your mind. If you let out a commercial property, then you can apply this case law of Chennai Properties and Investment Limited. But if you apply what? If you apply if you let out what? A residential property, then there is no option now from Finance Act 2024 that it will always go under income from house property. I hope it is clear to all of you. Okay. Let's go ahead with the next point. This is what we have done as an analysis of what is business, what is profession, what can come under PGBP, what cannot come under PGBP. Now let's talk about the next part of the charging section, that is profits and gains. What is profits and gains? First of all, the profits and gains, if it has to come under PGBP, it has to be revenue profits. Revenue profits are covered over here. Capital profits are not covered here. If you want to charge capital profits, then you need to make separate charging section. Capital profit cannot get charged under section 28(1). That is the general charging section. Secondly, profits may be legal, illegal, it doesn't matter. Profits may be cash, kind, it doesn't matter. Profits must be real. If you want to charge your profits under section 28(1), the profit has to be a real profit. It cannot be a notional profit or a deemed profit or an anticipated profit. If you want to charge a notional or a deemed or anticipated profit, then you have to go under what? Under 44AD, 44ADA, 44AE, presumptive income. Go under presumptive income and charge there. Then you cannot come under PGBP general provisions. Okay. If you want to charge under general provision, the profit has to be a real profit. It cannot be a deemed profit. Next part of the charging section, the business should be carried on by the assessee. Carried on by the assessee means what? Carried on by the assessee means the business should be controlled by the assessee. Okay, the assessee should be in the control of the business. It is not necessary that all the day-to-day activities should also be done by the assessee. Not necessary. The control, the power has to be, the decision-making power and the control has to be in the hands of assessee. Then you can say that the business is carried on by the assessee. Okay. Similarly, last paragraph, the term any time during the previous year. It means what? It means you need not have to conduct business for all the 12 months. Even if you conduct the business for some time during the previous year, then that is also considered to be what? Part of section 28(1). Further, it is not necessary that the business should be conducted in the AY. It may happen that you have done the business in PY. In the AY, the business is closed down. It may happen. It is very normal. So if the business is closed down in the AY, it's okay. There is nothing wrong in that. Okay. So this is what your general charging section is all about. Now let's come to the computation statement. How to compute PGBP income? This is given under section 29. How to compute PGBP, sir? You have to follow section 30 to 43D. What is given in 30 to 43D? In 30 to 43D, there are three things given. One is deductions, another is disallowance, third is deemed income. You read all of them, you will understand how to compute PGBP income. But before that, you need to maintain some books of accounts also. So how to maintain books of accounts? Maintain books of accounts as per section 145. And in 145, there are three subsections. The first subsection says that if you are covered under PGBP or under IFOS, either of the two heads, then you have two options. You can follow the books of accounts as per mercantile, which is your accrual system, or you can follow your cash system, whichever is regularly followed by the assessee. You can follow either of them, but whichever is regularly followed by the assessee. Okay, so you can follow mercantile system, you can follow cash system, whichever is regularly followed, you can follow either of them. Okay, now if you are following mercantile system, you have two options, mercantile or cash, but follow regularly. If you follow mercantile, then you have to follow the accounting standards given by whom? ICAI? No. Now ICAI accounting standard does not have any value under the income tax law. You have to follow the income computation and disclosure standards. Okay, not the ICAI accounting standard. And subsection 3, what does it say? If you are not complying with subsection 1 and 2, if you are violating subsection 1 and 2, then the AO will initiate best judgment assessment against you under section 144 that we will see in the chapter of assessment procedure. Okay, that will come later on. Today we are not talking about that. Now there is a synopsis of all the deductions over here. All the deductions are segregated into two parts. 30 to 36 are specific deduction. 37 is a general deduction. In specific deduction also there are two categories which are available to all the assessee, which are available to certain sector wise. Okay, so there are two categories in specific deduction as well. Now let's move on to some special charging section now. Some special charging, we have done the general charging. Now our duty is to address the special charging section, because charging section, all of them should be done together only. Let's start with special charging section. The first special charging section is if I am giving some money to anybody for not doing any activity in relation to business and profession. I am telling you, don't do this business. Take this much money, one shot. Take 10 crore, 20 crore, 100 crore, 200 crore. Don't do this business. Then it will be taxable in your hand. This is called as a non-compete fees. So if you pay any non-compete fees to anybody for not doing any activity in relation to any business and profession, then it is taxable in the hands of the person who is receiving it. And the person who is giving it has to deduct TDS under 194J at the rate of 10% if the recipient is a resident. If the recipient is a resident, then deduct TDS under 194J at the rate of 10%. If the recipient is a non-resident, then deduct TDS under section 195. Okay. Next section, 28(4). If you are giving any value of any benefit or perquisite from business and profession, if your client is very happy with you and your client has given you some gift, some business benefit, some business perquisite. Suppose somebody has given me some watch or a phone or any other foreign trip, then that is a business benefit, business perquisite, that is taxable in my hand. Okay, that is taxable as income from business and profession as a charging section, special charging section. Similarly, the person who is giving me will again deduct TDS under 194R if the recipient is a resident. Okay, 194R TDS will be deducted by the payer. Next one, Keyman insurance policy. Sir, what is the treatment of Keyman insurance policy? That depends upon who is receiving it. Keyman insurance policy is 100% taxable. There is no doubt about it. But under whose hand it is taxable, that is important. If it is received by employer, that it is taxable under PGBP. If it is received by employee, then it is taxable under salary. If it is received by nominee of the employee, the family members of the employee, then suppose the employee is dead and the family members are receiving, then it is taxable as income from other source. Okay, I hope it is clear to all of you. Next charging section is with respect to export assessees. If you are engaged in import and export, then the next 3 points would be more relevant to you. Suppose if the government is giving you an import license to import certain things, say raw material, etc., and if you sell that import license, and there is a profit on import license, on sale of import license, then that will also be covered under what? Business and profession under section 28. Similarly, if you are getting some duty drawback of customs, in customs you get duty drawback, that is a refund of custom duty on import and export, and if you are receiving some duty drawback on customs, then that is also income from PGBP, which is chargeable under section 28 special charging section. Similarly, if you are receiving any cash assistance against export, you are doing some export and the government is giving you what? Cash assistance. The government is telling you that you export this much amount of goods, we will give you 10 crore rupees as cash assistance. So that 10 crore rupees will be chargeable under business and profession. I hope it is clear to all of you. And one last thing over here, the charging section does not get over here. Later on also at many places charging section will come. We will be talking about that as and when the requisite point will come. As of now, whatever charging sections were independent of any other concept, we have done all of them. Okay. Now, section 28 special charging section relating to compensation received in business. If I am entering into a contract with someone, business contract, okay, and if the other person is terminating the contract, or if the other person is modifying the contract, for that he is giving me some compensation, then that is also chargeable under PGBP. But this is only applicable for termination and modification of a business contract, not a profession contract. Okay, so if somebody is terminating or modifying a profession contract, then that is not chargeable under PGBP. I hope it is clear to all of you. Okay, similarly, if you are terminating your employment contract and if you are receiving some money from the employer in relation to termination or modification of employment contract, then it is chargeable under what? It is chargeable under income from other source. Okay. So if business contract is terminated, chargeable under PGBP. If employment contract is terminated, chargeable under income from other source. I hope it is clear to all of you. Now, let's move on to the second part of business and profession, and that is we are going to start with deductions now. And in deductions, we are going to start with the biggest deduction of PGBP and probably of the entire income tax law, and that is depreciation. So let's start with the deduction of depreciation first of all. So first of all, let me tell you there are 4 types of depreciation under the income tax law. First is section 32 subsection 1 clause 2. This is called as normal depreciation under the block scheme. Second is 32 subsection 1 clause 2A. This is called as additional depreciation under the block scheme. And these first 2 depreciations are on WDB basis. These are not on SLM basis. The third and the fourth is SLM depreciation. That is only for power generating units, and terminal depreciation for power generating unit, that we will see at the end of this particular part. Okay. Now let's talk about the first one, that is the normal depreciation under the block scheme. To claim the normal depreciation under the block scheme under section 32 subsection 1 clause 2, you have to fulfill certain conditions. The very first condition is you need to be the owner of the asset. Sir, what do you mean by the term owner? The term ownership unfortunately is not defined under the income tax law. Therefore, we have to go to the Supreme Court judgment of Mysore Minerals Limited, which says that owner means beneficial owner and not legal owner. What is relevant is you need to be the beneficial owner of the asset and not the legal owner of the asset. You may not be the owner on paper, it's okay, but you have the right to use the asset. That is called as an owner. I hope it is clear to all of you. Just remember this line, owner means beneficial owner and not legal owner. Okay, registration, title, all are not relevant. Similarly, who can claim depreciation in case of lease and hire purchase? So there is a CBDT circular of 2001 for lease and CBDT circular of 1943 on hire purchase. Therefore, in case of lease transaction, it is said by CBDT, the lessor will claim depreciation, and in case of hire purchase transaction, it is said that the hire purchaser will claim the depreciation. I hope it is clear to all of you. Now there is a beautiful judgment of Supreme Court on this depreciation ownership only and depreciation use only. Before that, I would like to explain you one term more which is necessary to claim depreciation. That is, if you want to claim depreciation, you need to use the asset. Now, what do I mean by the term use? Use means active use as well as passive use. Sir, what do you mean by active use as well as passive use? This laptop, this iPad, this computer, this camera, I am actively using. I have one more in spare that I am passively using. Fire extinguishers are kept in my office. That is not used on a daily basis. It will only be used when there is a fire. So that is passively used. So even if a passive use is there in the business, which is ready for use in the business, on that also you can claim depreciation. Okay. One more thing, if you have purchased the machinery and because of some extraordinary reason, you are not able to use that machinery, maybe because of the shortage of raw material in the industry, because of that you are not able to use the machinery. So this is an extraordinary reason, it is not in your control. So then also you can claim depreciation. You can check it over here. I hope it is clear to all of you. Now I will come to this beautiful case law of ICDS Limited versus CIT. I will explain you the facts of the case first, and then we will understand what the court has to say. Suppose I am an SSE and I am an NBFC, non-banking financial company, and you are my customer. What am I doing with you? I am giving you car on lease. What I am doing? I am giving you cars on lease. So what kind of lease I am giving you? I am giving you car on a long-term lease of 3 years, 4 years, 5 years. You will come to me, you will tell me I want this car, and I will give you that car. I will buy that car from the market. I will give you that car, and after the end of the term of the lease period, you will give me back that car. Now, there is a requirement of Motor Vehicle Act that during the lease period, the car has to be in the name of the customer. The car cannot be in my name. The car has to be in the name of the customer. Now, keeping this thing in mind, the officer is saying that the lessor, the company, the NBFC, the lessor cannot claim depreciation. He is telling 2 points because of which he is saying that you cannot claim depreciation. First, because I am not the owner. The owner on paper is what? Is the customer. Second, because I am not using the car actually. The car is actually used by the customer. The car is driven by the customer. I am not driving the car. The matter went to the Supreme Court. The Supreme Court struck down both the points and said that the assessee is the owner. First point, owner means what? Beneficial owner and not legal owner. At the end of the lease period, the car will go back to the lessor. It is not the owner's, it is not the customer's property. It has been just given to the customer for use. And what is written in the Motor Vehicle Act is only relevant for Motor Vehicle Act. That till the time the customer is using the car, the ownership has to be in the name of the customer. That is the requirement of Motor Vehicle Act. That cannot be stretched to what? To the Income Tax Act. Therefore, the ownership is in the hands of the company. Second, the court said that use does not mean actual use. Use means in the course of the business. In case of a leasing business, a lessor cannot himself use the car. In the course of a lease business, leasing a car itself is a use of that car in the business. If I am in the business of leasing a car, giving a car on lease can be called as that I am using that car for my business and profession. Use does not mean actually I have to drive it. Okay, use means it has to be used in the course of business, and because of that, the court gave a judgment in the favor of the assessee, and ICDS Limited claimed the depreciation. I hope it is clear to all of you. Now let's move on to the next part of the depreciation, that is under income tax law, we claim depreciation under the concept of block of asset. The block is defined under section 211, and block means what? The government has divided all the blocks into two categories. First, tangible and intangible asset. And then intangible assets, there are plant and machinery, furniture and building. First of all, few basic things I will tell you. By default, the rate of plant and machinery is 15%, the rate of building is 10%, the rate of furniture is 10%, the rate of intangible asset is 25%, and on goodwill, you do not get depreciation from 2020-21 onwards. Before that, we used to get it. But from Finance Act 2020 onwards, on goodwill, we don't get depreciation. Now, all of them are allowed on a WDV basis. Now, there are some special rates. Special rates for building. If a building is a residential building, then it is 5%. And if a building is a temporary structure, then it is 40%. There are no special rates for furniture. For furniture, there is only one rate, that is 10%. Yes, but for plant and machinery, there are multiple special rates. There are no special rates for what? Intangible assets also. All intangible assets except goodwill. Goodwill is not eligible for depreciation. All intangible assets except goodwill will be eligible for 25% depreciation WDV basis. Now, for plant and machinery, there are multiple rates of depreciation. Let's talk about motor vehicle first. By default, motor vehicle will be depreciated at 15%. But if you are in the business of running the motor vehicle on hire, then you are using it more. Therefore, you will get 30%, 15% extra. And plus, if you have purchased and put to use the motor vehicle between 23rd August 2019 to 31st March 2020, between this period, if you have purchased and put to use that vehicle, then you will get 15% extra further. That is means if you are getting 15, then you will get 30. If you are getting 30, then you will get 45. I hope it is clear to all of you. But for that, the criteria is you would have purchased the vehicle and put to use the vehicle between these 7-8 months. Then only it is eligible. Now, shall I do one great interlinking? So if I purchase and put to use the vehicle between 23rd August 2019 to 31st March 2020, and if I'm also in the business of running them on hire, then I will get how much? 30 plus 15, that is 45%. But if you are following the special tax regime like 115BAA, 115BAB, 115BAC, 115BAD or 115BAB special regime, in that case you will not get a depreciation of more than 40%. So in that case this 45% is not applicable. In that case only 40% is applicable, and such kind of questions are asked in examination. So this is the level of interlinking that we are going to do in our revision video. These are going to be one of the most comprehensive revision videos that you would ever see on internet. You will not find a more comprehensive revision videos than this. Okay, so make use of this and spread it to your friends in South India where there is a lack of revision videos, especially comprehensive revision videos in full English. I am trying my best for you all. Okay. Now, electric vehicle 40%, mobile phones and EPBX will be depreciated at 15%. Okay, computer and its peripherals. What? Computer and its peripherals like scanner, printer, then windmill, professional books, aircraft, pollution control equipment will be depreciated at 40%. Okay, all these. There are multiple assets which are depreciated at 40%, and last but not least, ships are depreciated at how much? At 20%. Okay. Now, one important condition that if you purchase the asset and put to use for less than 180 days, in the same year of purchase, then it will become half, then it will become half, then it will become half. Be very careful. If I purchase in 24-25 and if I put to use in 24-25 for less than 180 days, then it will become half in 24-25. Otherwise, it will not become half. Okay. Similarly, if I purchase in 24-25 and if I put to use for less than 180 days in the next year, if I purchase in 24-25, I did not use only, I did not open the asset only. Next year I am opening the asset and next year I am using it for less than 180 days, then in the next year it will not become half. The condition for becoming half is only applicable in the year of purchase. It is not applicable in the subsequent years. I hope it is clear to all of you, right? Now let's go ahead. Then what is the definition of machinery? Machinery is not defined, building is not defined, furniture is not defined, but plant is defined under the income tax law. Rest of the assets are not defined. Sir, how plant is defined? Plant is defined in an inclusive manner as well as in an exclusive manner. Plant includes few things like ships, like vehicles, like books, like scientific apparatus, like surgical equipment. Plant does not include few things like tea bushes. Plant does not include tea bushes. Plant does not include livestock. Plant does not include building, furniture and fitting. You cannot say your building as plant and claim 15% depreciation on that. You cannot claim your furniture and fitting as plant and claim 15% depreciation on that. That is not allowed. Next, in order to claim depreciation under the block scheme, you need to fulfill two conditions on the last day of the financial year. For us, the last day of the financial year is 31st of March 2025 because for us the previous year is 24-25. So on 31st of March 2025, we need to fulfill two conditions if we want to claim depreciation. First condition, the amount column of the asset should be positive. The amount should not become negative. Okay, the amount column should be positive and the quantity column should have at least one asset. It should not become zero. Okay, the quantity column should not become zero and the amount column should not become negative. Both the conditions have to be fulfilled. If you fulfill both the conditions, the amount column positive, quantity column at least one asset, only then you can claim depreciation. Otherwise, it is not allowed to claim depreciation. Okay. Next point. Is it mandatory to claim depreciation? Absolutely yes. It is not optional to claim depreciation. You cannot make an excuse that I don't want to claim depreciation. You have to claim depreciation. It is mandatory for every assessee to claim depreciation. Okay. Now, let's come to the next point. That is, what is WDV? Because we are going to claim depreciation on WDV method, so we need to know the definition of WDV. Sir, what is WDV? The WDV is defined under section 43 clause 6. How it is defined? It is nothing but actual cost of the asset minus depreciation actually allowed to the assessee. So whatever is the cost of the asset minus depreciation, whatever is actually allowed to the assessee, reduce that, you will get the WDV of the asset. Okay, it is very simple. There is one exception to this, whereby your partial business is business and partial activity is agriculture, like tea, coffee, rubber. You are growing tea and you are manufacturing tea. You are growing rubber, you are manufacturing rubber. You are growing coffee and you are manufacturing coffee. Then in that case, you are doing partially business, partially agriculture. But in that case also, you will compute depreciation in a normal way only. Suppose if I am engaged in tea, coffee, rubber business and if I purchase a plant and machinery of 10 lakh rupees, then you have to compute your depreciation normally minus 15%. It is not that in that case you will segregate that this much is agriculture, this much is exempt, this much is no, nothing has to be done while computing depreciation. While computing depreciation, everything has to be computed normally. 10 lakh is the cost of the asset minus 15% depreciation directly reduced. The way we do it for others, the same is the case for these people also. There is no separate calculation for these people. That's what I'm trying to say you all. Okay. Now let's move on to the next depreciation, which is very important. At lot of places it will come as an adjustment in your question number 1 in the exam, and that is the additional depreciation under section 32 subsection 1 clause 2a. Now who is eligible for this depreciation? This depreciation is eligible if you are engaged in manufacturing of any article or thing, or if you are engaged in generation or distribution or transmission of power. If you are engaged in these two business, you are eligible for the deduction under additional depreciation. What am I supposed to do? You are supposed to acquire, install and use new plant and machinery. You have to acquire, install and use new plant and machinery. You will get 20% additional depreciation. Whatever normal depreciation is there, that you will get. Apart from that, you will get 20% additional depreciation. Sir, will this additional depreciation be also become half if I put to use the asset for less than 180 days? Yes, this additional depreciation will also become half if you put to use the asset in the current year, in the year of purchase for less than 180 days. Sir, what about the balance 50%? The balance 50% will be allowed to you in the subsequent year. Okay, suppose in the current year I purchase a machinery, new machinery of 10 lakh rupees in the month of December and I have put to use. So now I am using for less than 180 days. So 10% I will claim, that is 1 lakh additional depreciation I will claim in the current year, and 1 lakh I will be claiming in the immediately next year. Okay, no issues in that. Sir, will this additional depreciation also be reduced from the block of asset? Yes, this is also like a depreciation. Therefore, this will also be reduced from the block of asset. Next, sir, is this additional depreciation I am going to get every year? No. On one asset, only one time. It's a one-time benefit for one particular asset. Next year, if you purchase another new plant and machinery for manufacturing purpose, you will again get additional depreciation. Only one time on one asset. Okay, be very careful with that. Okay, sir, whether printing and publishing will amount to manufacturing, CBDT has clarified that if you are engaged in printing business or if you are engaged in printing and publishing both, then it amounts to manufacture, and therefore you are eligible for what? Additional depreciation. Yes, if you are engaged in only publishing, then you are not eligible for what? Additional depreciation. So are there any exclusions of machinery which I have to purchase? Yes, you have to purchase a new plant and machinery, and you don't have to purchase certain machinery that I am going to tell you now. You cannot purchase first of all a second-hand plant and machinery. Even imported second-hand plant and machinery is not allowed. Indian second-hand plant and machinery is not allowed. Imported second-hand plant and machinery is also not allowed. Further, any plant and machinery which is kept as an office premise, not allowed. Any plant and machinery which is kept as a residential accommodation, not allowed. Like refrigerator, if you are putting it office, microwave you are putting in office, like you are saying computer you are putting in office, like AC you are putting in office, not allowed. Okay, ships not allowed, aircraft not allowed, road transport vehicle is not allowed. But if the vehicle is a specially designed vehicle like forklift trucks which is used inside the factory, be very careful. Road transport vehicle are not allowed. But if a vehicle is a specially designed vehicle which is used inside the factory, then that will be eligible for what? That will be eligible for additional depreciation. Be very careful. Okay. Then any plant and machinery which is already allowed as 100% deduction at some or the other place. If you have claimed 100% tax benefit at any other place, then on that plant and machinery you cannot claim additional depreciation. For example, you have purchased a plant and machinery for scientific research purpose. For that, you have already claimed 100% deduction in the section of scientific research, so you cannot claim additional depreciation. Or if you have purchased 100%, if you have purchased some plant and machinery for 3580 investment in deduction, there you have already claimed 100% deduction of plant and machinery, so you cannot claim what? You cannot claim additional depreciation on that machinery. Last but not least, additional depreciation is only available if you follow block of asset method. If you follow WDB method, if you follow SLM method, because for power generating people, two options are there. They can go for WDB also, they can go for SLM also, which we are going to see now. So if they go for SLM, then additional depreciation is not allowed. If they go for power generating, if they go for WDB, then only additional depreciation will be allowed to them. I hope it is clear to all of you. Now let's move on to the next part, which is a big part of depreciation. That is WDB means what? Again, I will ask you. WDB as per section 43(6) means what? Actual cost minus depreciation actually allowed. Therefore, the next question which should come to our mind is, what do I mean by the term actual cost? Okay. So that is the next question that should come to our mind. Sir, what is actual cost? Actual cost means actual cost of the asset as reduced by that portion which is made by any person or authority. Whatever is the actual cost of the asset, you have to take that. What do I mean by actual cost, sir? Actual cost means all the expenses that are necessary to put the asset into working condition, take into that. Whatever expenses you have to incur to put the asset into working condition, that will form part of actual cost. If you are giving some installation cost to, if you are paying some salary to some technician to install the machinery, that is a part of what? Putting the asset into working condition. Therefore, that is also actual cost. If you are taking a loan for an asset, until the time you have not put to use the asset, that is also actual cost. So all those expenses which are necessary to put the asset into working condition are actual costs. Plus, if any portion is made by any person or authority, like somebody has given you some subsidy, grant, reimbursement, say government has given you some subsidy to purchase a machinery of 10 lakh, the government has given a subsidy of 1 lakh rupees. So that much you can reduce from the definition of actual cost. Okay. On that much portion you cannot claim depreciation. Further, this is a very important paragraph which will play a very important role in your examination while solving the question. That is, if you purchase any asset and if you make the payment to one person in a day for more than 10,000 rupees, then you have to make sure that you need to make the payment by account pay check, account pay draft, ECS or such other electronic mode as the government has prescribed. You have to make the payment by 4 modes: account pay check, account pay draft, ECS or such other electronic mode as may be prescribed by the government. More than 10,000 rupees to a person in a day. So if you make a payment of more than 10,000 rupees to a person in a day, and if you make the payment by other than these 4 modes, then your expenditure will not be considered under actual cost. And if your expenditure is ignored for actual cost, then you cannot get depreciation or even additional depreciation on that asset. Both will be gone. Up to 10,000 you make as much payment as you want in cash, but more than 10,000 it is not allowed. Sir, bearer check is allowed? Not allowed. Account pay check has to be there. Sir, cross check is allowed? Cross check is also not allowed. Account pay check has to be written. A check on which there is a cross and there is written account pay on the top left. Then only it is called as account pay check. So bearer check absolutely not allowed. Cross check absolutely not allowed. About 10,000 to a person in a day. Be very careful. Okay. Then, sir, if I have taken a loan for asset, then what will be the treatment of the interest? Very simple. If I have taken a loan for an asset, if I have taken a loan to purchase an asset or to construct an asset, so till the time the asset is not put to use, you will capitalize the interest the way you do in accounts in your financial reporting. Once the asset is put to use, you can claim the interest as a revenue expense under section 36 subsection 1 clause 3. You can claim that as a revenue expense. I hope it is clear to all of you. Now there are some extracts of ICDS over here which will explain us exactly that what has to be the treatment of different expenses with respect to an asset. For example, if there are admin and general overheads which are not related to the fixed asset, then it has to be excluded from the cost of asset. If it is not related to the fixed asset, then exclude from the cost of asset. Yes, if the expenses are specifically attributable to a particular project, then and which is necessary to bringing it into working condition, then it has to be included as a part of cost. Then you have to include that as a part of cost. Okay, which that is what I have told you just now. Similarly, if you are incurring some expenses on startup, commissioning, test run of a project, so you are testing the machinery, on that you are incurring some expenses, so you have to capitalize because that is necessary to put the asset into working condition. Similarly, once the production has started, your business has started, your sale has started, then your expenditure should go to what? Revenue account. It should go to your P&L account. You can claim that as what? As a revenue expense. I hope it is clear to all of you. Now, there is one ICDS on borrowing cost also, which is there in your accounts also, financial reporting also. There is one accounting standard 16, and I don't know which Ind AS is there for borrowing cost under the financial reporting. But there is an Ind AS definitely and an accounting standard definitely on what? On borrowing cost. So how will you what? How will you capitalize the borrowing cost? That's what this borrowing cost is going to tell us. See, there are two types of loan that you can take for an asset. One loan you have directly taken for a qualifying asset. First of all, we need to understand the meaning of qualifying asset. Qualifying asset is not defined under income tax law. We have to follow the qualifying asset definition under the financial reporting only. So what is the definition of qualifying asset as per financial reporting? Qualifying asset means an asset which takes substantial period of time for it to be ready for its intended use, generally more than 12 months, generally. But it can be less than 12 months also. But generally, if an asset is taking more than 12 months for it to be ready for its intended use, you can call that as an asset as what? As a qualifying asset. So, if you have taken a loan directly for a qualifying asset, then don't think much and you have to directly what? You have to directly capitalize that expense to the cost of the asset. Okay, to the qualifying asset, you will directly add back to the qualifying asset. But the problem starts where there is a general loan which you have taken, out of which you have taken a general loan of 10 lakhs. Some portion of that is in qualifying asset, some portion of that is in some other asset, some portion of that is in bank account, some of them is in cash account, some of them is in data, some of them is in cash. So how will you capitalize that in case of a general borrowing? So for general borrowing, the government of India in the ICDS 9, they have given a formula. So if the funds are generally for what? Qualifying asset, then you have to capitalize based on this formula. So what is A? A into B divided by C. So what is A? A is your borrowing cost of general borrowing, except the borrowing which are directly relatable to the, which are covered over here. So except this borrowing, whatever is the general borrowing, take the borrowing cost of that, that will be point of number A. That will be your interest cost or borrowing cost of general borrowing. Okay. After that, what is B? B I will tell you in a while. First I will tell you C. What is C? C is the division, that is divided by. divided by C is the average of the total assets on the balance sheet as on the first day and the last day of the previous year. So 1st April 2024 and 31st March 2025, take the average of both the date and that will be considered to be your point number C. And B depends upon case to case. Average of the cost of the qualifying asset on the first and the last day of the previous year. So B changes depending upon facts and circumstances. In first case, what is the B? 1st April, take the value of the qualifying asset. 31st March, take the value of qualifying asset, divide by 2, take the average. Now, in case the qualifying asset does not appear in the balance sheet on first day, is it possible? On 1st April, qualifying asset is not there because the asset started from June. Maybe it was not there from the beginning of the year, possible. Or it is not there on both the days. It started in June and completed in December. Then what shall I do? So if it is not there on the first day, or if it is not there on the first day as well as the last day, then take the half of the cost of the qualifying asset. That will become your point number B. Okay. And point number B3, qualifying, in case the qualifying asset does not appear in the balance sheet on the last day, it means it appears on the first day. So on 1st April, the qualifying asset is there. On 31st December, the asset is no more qualifying. So take the average of 1st April and 31st December, divide by 2, check. Take the average of 1st April and the date on which the asset is put to use, divide by 2. That will become what? That will become your point number B for the purpose of this attribution. Okay. So this is what the definition of actual cost is all about. Now, the definition does not over here. There are around 13 explanations which are attached below the definition. Some of them are relevant to some other concepts. I will be addressing each and every explanation with the relevant concept. I may not tell all of them today. In the class also, I have not told all of them together, but at the end of the batch, you also know I have covered all of them. So 13 explanation in case of actual cost, where actual cost is something else, where the government of India has defined actual cost to be something else only. Which are those 13 cases? Let me talk about one by one all of them. First and the second one I am not going to deal now. First, I will deal later on in this chapter only along with scientific research. Second, I will deal in the chapter of capital gains, not today. So I am starting with the second explanation. What is the second explanation? Where an asset is acquired by way of gift. Somebody has gifted me asset. Somebody has given me asset on will. Somebody has given me asset on inheritance. So if I have got the asset by way of gift, by way of will, by way of inheritance, then what is actual cost? Then actual cost is the actual cost to the previous owner who has gifted me less depreciation actually allowed to that person. In short, whatever is the WDV in the hands of that person, that will become my actual cost. I hope it is clear to all of you. In case you have in case you have received the asset by way of gift, by way of will, by way of inheritance. Okay. Second, suppose if I have purchased the asset from somebody at a very high price, an air condition of 15,000 rupees I am purchasing for 10 lakh rupees. So my objective is to claim higher depreciation. So if I acquire the asset with an intention to claim higher depreciation at a very high price, in that case, the actual cost will not be 50,000. Sorry, the actual cost will not be 10 lakh rupees at which I am buying it. The actual cost will be determined by the AO with the prior approval of Joint Commissioner. AO will determine, but he will take an approval from Joint Commissioner and generally he will determine what? He will take the fair market value of such asset to be the cost of the asset. Is it clear all of you? I hope it is clear. Third, if I sell my asset to, I am Mr. A, I sell my asset to Mr. B, Mr. B is selling to Mr. C, Mr. C is selling to Mr. D, and then I am again reacquiring from Mr. D, then what is the actual cost? What is the actual cost in case of reacquisition of assets sold? Once sold and then again taken back. Then it is WDV at the time of original transfer. Original transfer means when I sold to Mr. B. So when I sold to Mr. B at that time, what was the WDV? Compare with when I sold to Mr. B, what was the WDV? Compare with when I reacquired the asset, what was the purchase price? Whichever is lower, that will become my actual cost. I hope it is clear to all of you. Next one, explanation 4A. I'll explain you with the help of an example. I am Mr. A, you are Mr. B. You have purchased an asset of 1 lakh rupees. I am Mr. A, you are Mr. B. You have purchased an asset of 1 lakh rupees. On that asset, you have claimed depreciation, say 20,000. Now the WDV of the asset is 80,000. Now you are selling that asset to me for 2 lakh rupees. What is the WDV of that asset? 80,000. You are selling that me for how much? 2 lakh rupees. Now I am leasing back that asset to you after purchasing from you. I am purchasing that asset from you from 2 lakh rupees and then I am leasing back to you. So once you purchase an asset and lease back, then what is the actual cost? Is it 2 lakh rupees? Is it the price on which I have acquired? The answer is no. It is the WDV in your hands. And what was the WDV in your hands? It was 80,000. That will become my actual cost. Are you clear? If I purchase something from someone and then I lease back that item back to that person, then WDV in the hands of transferor becomes my actual cost. Check. Okay. Next explanation 5. Explanation 5 divides all the assets into two categories. Building is separate, plant machinery furniture is separate. Let's talk about plant machinery furniture. Plant machinery furniture. If there is a personal plant, personal machinery, personal furniture which is kept at my home, now I am bringing that to business. My personal car I am bringing to business. My personal mobile I am bringing to business. Personal laptop bringing to business. What is the actual cost? The actual cost remains actual cost. There is no separate explanation for plant machinery furniture. But yes, if you bring your personal building into business, if you bring your personal building into business, if you make your house as your business house, if you make your house as your business property, if you make your house as your office, then actual cost has to be determined as per explanation 5, which says it is the original cost of the building less notional depreciation for number of years the building was used for personal purpose. As per the depreciation of the current year, the rate of depreciation will be of the year in which you are converting the asset. Okay. So suppose you have purchased the building in 2015 and you are converting into business asset in 2024-25. So you will reduce from 2015 to 2023-24 as per the rate of 24-25. The rate of depreciation will be of the current year. I hope it is clear to all of you. Now next, explanation 6. What is explanation 6? If an asset is transferred by 100% holding company to subsidiary company or subsidiary company to holding company, I am holding company, you are subsidiary, you are holding company, I am subsidiary. If we transfer any asset between us, then what is the actual cost in the hands of the recipient? It is the WDV or the cost to the transferor that will become the cost in the hands of the recipient. So whatever is WDV in my hands, that will become your cost. Okay, I hope it is clear to all of you. The same is the case in case of amalgamation and demerger also. Amalgamating company, I am amalgamating company, you are amalgamated company, I am transferring you some asset in the course of amalgamation. What is the actual cost in the hands of you? That is, you are amalgamated company. WDV or cost in my hands will become your actual cost. I hope it is clear to all of you. Same is the case with demerger. I am a demerged company, you are a resulting company, I am transferring you the asset. So WDV in the hands of the demerged company will become the cost in the hands of the resulting company. I hope it is clear to all of you. Now let's move on to the next point. Next point I have already told you. That is asset acquired out of borrowed funds. Once the asset is put to use, after that what will happen? It will never form part of actual cost. So I have taken a loan, and once the asset has been put to use, after that the interest will not go to the actual cost. The interest will go to the P&L account. I hope it is clear to all of you. Next one, explanation 9. It talks about GST credit. Okay, what happens in case of GST credit? In case of GST credit, the government says that if input credit is claimed, you have taken a GST credit on a particular asset. I bought a machinery on which I have claimed GST credit, then you cannot claim depreciation on that portion. That portion shall not form part of actual cost. I hope it is clear to all of you. I purchased a mobile phone of 1 lakh rupees on which 20,000 rupees is GST, for example. So if I have claimed that 20,000 rupees GST as an input credit, then on that 20,000 I cannot claim depreciation under the income tax law. I hope it is clear to all of you. Next one, very important explanation. If I am getting some government grant, or if I am getting some subsidy, if I am getting some reimbursement, obviously for what? If I am getting some grant, subsidy or reimbursement, obviously for fixed asset, then in that case it will be reduced from the actual cost. You have to what? You have to reduce from the actual cost. As simple as that. And last but not least, if I am a non-resident and if I am bringing some asset into India, being a non-resident, I am bringing some assets in India. So if a non-resident brings some asset in India for his business and profession, suppose I am a non-resident, I stay in United States and I am bringing one computer from US to India for the purpose of business, then what is the actual cost of that computer? The actual cost of that computer will be the actual cost of the computer minus depreciation over the years. Suppose I purchased that computer in US in 2020. So I have to reduce the depreciation from 2020 till today, and then whatever is the amount will come, that will be the actual cost in my hands. In short, whatever is the WDV of that computer, that will become my actual cost in India. I hope it is clear to all of you. Now, the next point is related to explanation 10. What does explanation 10 says? Explanation 10 says that if there is a subsidy, grant or reimbursement with respect to an asset, then you have to reduce from the cost of asset. What about other subsidy, grant and reimbursement? If there is a subsidy, grant or cash incentive or duty drawback or waiver by central government, state government, any body, authority, other than explanation 10, other than this, then what will happen? Then it will be directly an income. You need to be very careful. If there is a subsidy, grant or reimbursement with respect to an asset, then it is what? It will be reduced from the cost of asset. If there is a subsidy, grant, reimbursement, waiver, duty drawback, etc., other than explanation 10, if it is not covered in explanation 10, then you will treat that directly as an income. Okay, I hope it is clear to all of you. So that is what it is given over here. If the subsidy, again I have repeated the things over here, if the subsidy is received for acquisition of an asset, then it should be reduced from actual cost. Okay. Now there are some relaxations given over here in the definition of income under section 224(18). This point comes a lot of time in the examination that the government has given you industrial tariff concession, the government has given you electricity concession. So whatever concession etc. government is giving you, that is a part of your income. Let it be part of PGBP. It is a PGBP income. Now there are two exceptions over here. If a central government is giving something to a central government trust or a state government trust, listen carefully. The giver is whom? The giver is central government. Who is the receiver? The receiver is central government trust or state government trust. Then it is not an income. Then it is not taxable. Further, if any benefit is given for personal benefit like LPG, liquid petroleum gas subsidy, LPG subsidy which the government used to give earlier, now they don't give, or any other welfare subsidy for the individual, that is also not taxable. Individual subsidies and benefits are not taxable over here. Only business subsidies and benefits are taxable over here. I hope it is clear to all of you. Okay. So you have to be very clear. If the subsidy grant reimbursement is with respect to fixed asset, reduced from cost. If it is for any other thing, then you have to take it as income. Suppose if the government is giving you subsidy for electricity bill or for purchasing raw material, then it is not for fixed asset. Then it is an income. As simple as that. Okay. I hope it is clear to all of you. Now there is one ICDS on this also. Let's see that. ICDS. This ICDS is on government grant. First of all, this ICDS tells us when government grant should be recognized. So the CBDT says that the government grant should not be recognized until you are sure about two things. I should not recognize government grant unless and until I am sure about two things. Unless there is a reasonable assurance. What is the reasonable assurance? That the person shall comply with the conditions attached. That the person to whom you are giving the subsidy or government grant, he will comply with the conditions attached, and secondly that the grant will be received from the government. Unless and until these two conditions are fulfilled, the grant should not be recognized. First, what is the first condition? That the person who is receiving the grant should comply with the condition and the government will also give the grant properly on time. Then only it should be recognized, otherwise it should not be recognized. Then the government says, once it is actually received, then there is no need to postpone the recognition. Then you have to recognize the grant. So this paragraph tells us the timing of recognition, when the grant has to be recognized. Now this paragraph tells us how the grant has to be recognized. Okay, how? What is the treatment? So treatment we have learned, like if it is for depreciable asset, then it has to be reduced from the cost of asset. Okay, I hope it is. The first point and the third point is for depreciable asset. The first point is for directly a depreciable asset and second point is for a group of depreciable asset. For example, I want to purchase a land of 1 crore rupees. So the government is saying that we will give you 20 lakh rupees. So that is directly related to land. So reduce from the land. And land is not depreciable, building. For example, building. So I want to purchase a building of 1 crore rupees. I asked the government for some subsidy. They said that we will give you 20 lakh rupees. So reduce 20 lakhs from the cost of the building. 80 lakhs will become your WDV. Okay, that will become your cost. Suppose if the government is telling, I want to buy 10 assets and the government is saying that we will finance you 20%. Then I have to proportionately reduce 20% from all the assets. Okay. Some portion from plant, some portion from machinery, some portion from computer, some portion from furniture, some portion from motor car. Because the government is financing for group of assets. So you will reduce proportionately for all of them. Now what if I don't fulfill the conditions in future? Then I have to refund the subsidy to the government. So what will be the treatment on refund? The treatment on refund will be opposite of what you have done on receiving the grant. On receiving the grant, what you have done? You have reduced from the actual cost. So on refunding the grant, what will you do? You will add back to the WDV of the asset or the cost of asset. Are you clear? So on receiving, you have reduced now from the cost of asset. So on refunding, you will add back. You will just reverse the treatment what you have done. So what about other grants? This was about depreciable assets. What about other grants? If the grant is receivable as a compensation, then it is taxable in the year in which it is receivable. So suppose there is some riot in your state, there is some earthquake in your state, God forbid. So if there is some compensation received because of that, so in that case you will be taxable in the year in which it is receivable. Okay, I hope it is clear to all of you. Similarly, where the government grant relates to non-depreciable asset, what shall I do if it is relating to non-depreciable asset? It is not relating to a depreciable asset, it is relating to non-depreciable asset. For example, the government has given me 100 crore rupees for purchasing raw material. So this will be recognized as and when I will fulfill my obligation. As and when I will purchase the raw material, I have to what? I have to recognize that much income. Suppose in the first year I purchased raw material of 30 crore. So I have to recognize 30 crore as income. In the second year, I purchase another 30 crore. So another 30 crore as income. Now how much is left? 40 crore is left. Now suppose after 2 years, the government says you are not complying with the condition and you have to repay entire 100 crore to us. But 60 crore I have already incurred. So 40 crore which is left in the unamortized part, that will be written off first and the excess 60 crore will be charged to P&L. After 2 crore in your balance sheet, only 40 crore is left not to incur. But the government is saying now you have to pay the entire money back. So if I have to pay entire money back, 60 crore I have to pay it from my pocket. That is my expense. That will be charged to P&L account. You can claim that as a deduction. And any other subsidy, grant, reimbursement, apart from these four, you can recognize as per the accounting concept, as per your matching concept. Okay, I hope it is clear to all of you. Okay. Now let's move on to the next part. If we are talking about depreciation, it is our duty to talk about also what is unabsorbed depreciation. The concept of unabsorbed depreciation is given under section 32 subsection 2. Sir, what is unabsorbed depreciation? Unabsorbed depreciation is that depreciation which cannot be claimed as a deduction in the current year because of insufficient profits. We don't have sufficient profits to absorb our depreciation. So how to treat that? You can set off that against any income, first against business income, then against any other income except salary. You can set off in the current year first against business income, then against any other income except salary. Then you can carry forward and set off against business income and any other income except salary. Except salary, you can carry forward against any other income. You can set off against any other income. Time limit for carrying forward. There is no time limit for carrying forward. You can carry forward till infinity, till your life. Okay. Forever you can carry forward. Plus, there are two more items which are treated just like this. I would like to do that interlink today only. Unabsorbed capital expenditure of family planning is also treated like this only, and unabsorbed capital expenditure of scientific research is also treated like this only, and all three of them, in case of amalgamation, it is given to the amalgamated company. All three of them. In case of amalgamation, if an amalgamation is happening suddenly, then all of them will be given to the amalgamated company. Unabsorbed depreciation also, unabsorbed capital expenditure of family planning also, unabsorbed capital expenditure of what? Scientific research also. Okay, this is the interlinking I am trying to do over here. So what is the priority of set off? If you have current year depreciation, if you have unabsorbed depreciation, if you have brought forward loss, then the priority of set off will be as follows. First, you will claim current year depreciation because it is mandatory to claim depreciation. Then you will claim business loss because it will expire after 8 years. Then you will claim UAD because it is never going to expire. It is there forever. Okay. I hope it is there till eternity. You can carry forward and set off forever. I hope it is clear to all of you. Now, next concept. Proviso to section 32(1) depreciation in case of amalgamation. Sir, how to claim depreciation in case of amalgamation? Very simple. In case of amalgamation, compute depreciation as if no amalgamation has taken place. Just assume no amalgamation has taken place and compute depreciation. And after that, sir, then segregate the depreciation between the amalgamating company and the amalgamated company or demerged company or resulting company or predecessor or successor on the basis of number of days the assets are used by them. So while computing, just assume nothing has happened and then segregate between both of them on the basis of number of days who has used the asset for how many days. Okay. I hope it is clear to all of you. Now coming to the third depreciation. After 32(1)(2) and 1(2)(a), that is the block depreciation and additional depreciation, we are now going to talk about SLM depreciation, which is a very small part, not a very big part. So in case of SLM depreciation, the section is 32 subsection 1 clause 2. It is only available if you are engaged in power generation business or power distribution business. Okay. If you are engaged in these two businesses, you are eligible for this deduction. How much depreciation I will get? Very simple. SLM every year same. So if you have purchased an asset for 1 lakh rupees and your rate of depreciation is say 10%, you will get every year how much? 10%, 10,000 for 10 years. Say for 3 years the depreciation is 30,000 and after 3 years the WDV will be 70,000. Now the real fund starts here. If I sell this asset now, then what will happen? So here the different treatments are there. If you sell the asset for less than WDV, then whatever difference is coming, that is called as terminal depreciation, and that is allowed as a deduction under section 32 subsection 1 clause 3. So if you sell the SLM asset for less than WDV, which I am doing over here in case 1, then the differential amount, that is 50,000 minus 70,000, will be treated as terminal depreciation and it will be covered under what? It will be deductible under PGBP. Similarly, tit for tat, if you are selling for more than SLM, if you are selling for more than WDV, that is if I am selling for 80,000, then the differential amount will be called as deemed income under section 41(2), which is called as balancing charge. What it is called as? Balancing charge. They have given a term by the name called as balancing charge. So what is balancing charge? Whatever depreciation you have claimed earlier, if you are making a recovery of that, listen to my words, it will be helpful in case C. Whatever depreciation you have claimed earlier, if you are recovering that, then that will be called as a balancing charge. Okay. Now, third case, if you are selling for 1,20,000, which is more than WDV also, which is more than cost also. So how much depreciation we have claimed earlier? 30,000. That much will be considered to be deemed income under 41(2). That much only will be balancing charge. And whatever we are earning over and above cost, how much we are earning? 20,000. That will be considered to be my capital gains. Are you clear? I hope it is clear to all of you. But in this case, capital gains has to be computed in a very intelligent manner. For computing capital gains, the government has given that the cost cannot be taken as 1 lakh. The cost cannot be taken as 1 lakh. Listen carefully. The cost cannot be taken as 1 lakh. You have to adjust your WDV and take an adjusted WDV as your cost. Sir, what is the adjusted WDV? In all the 3 cases, the adjusted WDV has to be found out. You have to find out new cost and that will be taken as a cost. Because of this, what will happen, wherever there is a loss coming now, the capital gain will become 0 at that place. And wherever there is a gain coming there, capital gains will remain capital gains. I'll show you how. For example, in case A, WDV is 70k. In case B also WDV is 70k. In case C also WDV is 70k. Correct? In all the 3 cases, WDV is same. So in case A, the government says that you cannot take 1 lakh as your cost. You have to adjust your WDV and find your revised cost over here. Okay. So in case A, add balancing charge less terminal depreciation. In case balancing charge is not there, terminal depreciation is there of 20k and this will become 50k and therefore your new cost is 50k, your selling price is also 50k, therefore your capital gains will become 0 in first case. In second case, add balancing charge. Yes, in second case there is a balancing charge of 10k and there is no terminal depreciation, therefore this will become 80k and in second case your selling price is 80k, therefore no capital gains. Okay. In third case, your terminal depreciation is not there, balancing charges of 30,000, terminal depreciation 0, therefore this will become 1 lakh and in third case the capital gains will become 20,000. Okay, so they have made the formula in such a beautiful manner that when there is a capital loss, that will become 0 and if there is a capital gain, that will remain gain. I hope it is clear to all of you. Now, one last thing in the discussion of depreciation, which is our biggest deduction out of all of them. That is comparison of 43A and 43AA. Now out of 2, 43A is very important for examination. 43AA, they have not asked much in the examination. So pay more attention on 43A. What is 43A? If you are purchasing an imported asset, if you are purchasing an asset from outside India and there is a foreign currency loan on it or foreign currency credit. So if I am purchasing from machinery, any furniture, computer, whatever from outside India and if there is a foreign currency loan or if there is a foreign currency asset, foreign currency supplier credit, then whatever gain or forex gain or loss which will come on the date of payment, not on balance sheet date, not on 31st March, whatever gain or loss which will come on 31st March, on the date of payment, not on 31st March, whatever gain or loss which will come on date of payment, that has to be adjusted in the WDV of the cost of asset. It means if there is a loss, you have to add back to the WDV of the asset, and if there is a gain, you have to reduce from the WDV of the asset. I have made you write a complete example on this in the class. Okay. I have given you a complete example on this. So whatever is your gain, you have to adjust on the WDV of the cost of asset. Okay, I hope it is clear. But this is applicable in a very specific scenario. That is only applicable under section what? 43A, if you purchase an imported asset and if there is a foreign currency loan. Otherwise not. What about other forex gain and loss? What if there is a forex gain and loss on debtors, on suppliers, on translation of foreign branches, on forward contracts, on options, and many other things forex gain or loss can come, correct or not? So any other gain or loss which is not covered in 43A, other than 43A, all of them will come in 43AA, and here it will be considered as an income or loss as per ICDS. Okay, as per ICDS it will be considered as an income. I hope it is clear to all of you. And here you have to treat them the way you treat in accounts. First, record them on the date of transaction, then on 31st March, you have to revalue them. Then on the date of settlement, you have to again check what is the gain, what is the loss. Okay. So the way you do in accounts, you have to do in the same manner in 43AA. Examples over here, you have to record the gain and loss for monetary, non-monetary items, translation of foreign financial statements, forward contracts, foreign currency, all of them. These are just some of the illustrative examples. Don't rely on this. Whatever gain or loss which is other than 43A will come in 43AA, and in 43AA you have to treat the way you treat in accounts. As simple as that. Okay, I hope it is clear to all of you. Okay. Now one last thing is there over here which talks about what? Which talks about ICDS on foreign exchange rates. Same the way you do in accounts. Initial recognition, then conversion on the last day of the previous year. Initial recognition means the date of transaction you will record as per the date of transaction. You also have an option to take an average for a week or a month, but if that fluctuates significantly, if the average fluctuates significantly, then you take on the date of transaction. Okay, the rate on the date of transaction. On the 31st March for monetary items, you have to record as per the closing rate. You also have if the closing rate is very unrealistic, suppose because of some reason the closing rate has increased too much or reduced too much, then you can take the amount likely to be realized or likely to be disbursed, the amount which you are likely to receive or likely to pay, you can record as per that. For non-monetary item, record as per the date of transaction and then revalue on closing rate. Okay. So this is the same thing which you do in accounts, financial reporting, the same thing you have to do it over here as per the ICDS. Okay. Here we complete the entire depreciation, which is the biggest part of PGBP. Now I'm moving ahead with some small deductions like section 30, 31 and 36(1). So these are the three small deductions which we are going to do now. After that, we'll go ahead with the sector-wise deduction. Okay. So let's start. What is section 30, sir? Section 30 talks about rent, rates and taxes, repairs and insurance of building. Now here you need to see you are using the building for business and profession or not. If you are not using the building for business and profession, then don't come here. And in that you also have to further ask yourself, the building is owned by you or you are a tenant in the building. If the building is owned by you, then you cannot get the deduction of rent, obviously, because you are the owner of the building. But if you are the tenant of the building and you are using that building for business and profession, then you can get rent also. So the tenant will get rent, the owner will not get rent. Rates and taxes, whomsoever will pay will get the deduction, but rates and taxes will be allowed on payment basis as per 43B. It will not be allowed on accrual basis. Be very careful with that. It will be allowed only on payment basis, not on accrual basis. As far as repairs are considered, both will get, whomsoever will incur the repairs will get, but only revenue repairs are allowed. Capital repairs are not allowed under section 30. Only revenue repairs. If you incur a capital repair, if an owner is incurring a capital repair, he can add to the cost of asset and claim depreciation. Okay. I am an owner of a building. I am doing a capital repair to my building. I can add to the cost of asset, claim depreciation. What about tenants, sir? For tenant also, the government has given a special benefit that if a tenant also does the capital repair on the building of the landlord, which generally will not happen, but still if it does, there is a possibility. I am a tenant of your building and I am doing a capital repair on your building, very rare, but I can do. It may happen. So in that case, the government says that it will be the deemed building of the tenant and he can also claim depreciation on the capital repair. Okay. So if a tenant does a capital repair on the building of the landlord, the tenant can also claim depreciation on that particular amount. I hope it is clear to all of you. And then insurance, if you pay insurance premium, that is also allowed as a deduction. Okay. Let's move on to the next section, 31, very small section. This covers repairs and insurance of plant, machinery, furniture. So if there is a plant, machinery, furniture which is used for the purpose of business and profession, if you are doing some, again, revenue repair, not capital, and if you are doing some insurance premium, then it is allowed as a deduction. Rent of plant, machinery, furniture is not covered here. That is covered under 37(1), subject to the conditions mentioned in 37(1). That is not covered over here. Okay, I hope it is clear to all of you. Let's move on to the next section, 36, which covers lot of small clauses. First, section 36, subsection 1, clause 1. If you are making an insurance premium for stock, if you are insuring your stock in trade, for that you are making some payment of premium, that will be allowed as a reduction under 36(1)(1). Similarly, if you are an employer and if you are making a payment for health insurance of your employee, then it is allowed as a deduction. Health insurance for employees. I am employer, you are my employee, I am doing health insurance for you all. It is allowed as a deduction to me, but only if it is paid other than cash. If it is paid in cash, not allowed. Third, bonus and commission paid to employees. It is allowed. First important point over here. If I am employer, you are my employee, bonus and commission paid to employees are allowed, but subject to 43B. It means it is not allowed on accrual basis. It is allowed on payment basis, and payment basis. Not allowed on accrual basis. Okay, first thing. Second thing which is mentioned over here, which is slightly technical, however, where some represents profits, then not allowed. What do I mean by this? Suppose there are four shareholders. Shareholder A, shareholder B, shareholder C, shareholder 3, all four are holding 25% shareholding. Now the third and the fourth shareholder are also employees. Third and the fourth shareholders are also employees. The first two are not employees. So the third and the fourth shareholder, I am giving them more bonus rather than dividend. I am giving dividend of 25,000 to first shareholders, 25,000 to second, and the third and the fourth, because they are employee, I am paying them only 5,000 dividend and remaining 20,000 I am giving them as a bonus. So I am showing the dividend portion as bonus. That is not allowed. If there are four shareholders, all should be getting the equal dividends. You cannot transfer your dividend into what? As what? You cannot transfer a dividend in the form of what? In the form of bonus. And if you do that, then that will not be allowed under income tax law. Okay. Next one, interest on borrowed capital. Section 36(1)(3). If you borrow money and you use that money for the purpose of business and profession, then interest will be allowed to you as a deduction. But you should use that money for the purpose of business and profession. Sir, what do I mean by use for the purpose of business? You have to use. It is very widely interpreted. Sir, if I use that for the purpose of payment of salary, rent, etc., it is allowed as a deduction? Yes, why not? Payment of salary, payment of rent is a part of business. It should be allowed as an expense. Sir, what if I take a loan to pay income tax? Is it allowed? Not allowed. Income tax is a personal tax. If you take a loan to pay income tax, it is not allowed. Sir, what if I take a loan to pay GST? Is it allowed? Yes, it is allowed. GST is a business liability. GST is a business liability and therefore it is allowed. I hope it is clear to all of you. Is it clear? Next, sir, what do you mean by the term interest? Is it defined under the income tax law? Yes, the term interest is defined under section 228A. Interest not only includes interest, but also includes any other service charge or any other service fee in relation to money borrowed. So whatever service charge, service fee you pay in respect of a loan taken from the bank or any financial institution, that service charge, service fee will also be called as interest as per section 2, clause 28A. Sir, if I have taken a loan and if I have given the loan to my sister concern or my subsidiary, will that interest be disallowed? That depends upon facts and circumstance of every case. You cannot just disallow based on this assumption that I have taken a loan and I have given it to sister concern. No. You have to look into the facts and circumstance of every case. If I have taken a loan and if I have given that loan to my sister concern, and if my sister concern is using that loan for the purpose of business and profession, then it should be allowed as deduction. If the sister concern is using for the personal benefit of the directors, then it will be disallowed in my hand. You have to look into the commercial expediency of the transaction as per the Supreme Court judgment of SA Builders and Delhi High Court judgment of Reebok India Limited. I hope it is clear to all of you. And last but not least, certain interest payments are subject to 43B, not all. If you take a loan from Indian bank or Indian financial institution, it is subject to 43B, then interest is allowed if it is paid. If you take a loan from foreign bank, foreign financial institution, then interest is allowed on accrual basis. This I will talk in the chapter of what? 43B later on. In this revision video only, don't worry. Okay. Next, 36(1)(3)(a), discount on zero coupon bond. Sir, how this is allowed? I am a company, you are my investor, and I am issuing you bond, you are paying me money. Say you are paying me 50 rupees. So on redemption, I will pay you 100 rupees. That 50 rupees is my cost because you are paying me 50 today. Tomorrow I have to give you 100. So that 50 rupees will be apportioned over the life of the bond, and that will be allowed as a deduction to the company. It will be allowed over the life of the bond. Okay. Now, while determining the life, you have to divide the life not by years, by months. Don't divide the life by years, divide the life by months. And if in a particular month there are 15 days or more, then you have to take that as a complete month. Suppose if I issue the bond on 13th of September, then you have to consider that month. Because from 13th September to 30th September, there are 15 days or more. So that month will be taken in the denominator. Suppose if I redeem on 12th of September, then don't take that month because it is getting redeemed on 12th of September and therefore the bond was there only for 12 days. And then you have to divide and then accordingly you have to claim the deduction, not a very important section for exam. But the next few points are extremely important for exam. Extremely important. Every second paper you will find such adjustments in the paper. 36(1)(4). What is 36(1)(4)? Employer contribution to recognized provident fund, superannuation fund is allowed as deduction. If I am employer and if I am contributing to employer PF, employer superannuation fund, then it is allowed as deduction to me, but subject to 43B. And what 43B says? You have to make the payment till the due date of filing of return. So I have to make, if I want a deduction of this first point, I have to make the payment till the due date of filing of return. Similarly, if there is an employer 36(1)(4)(a) who is making payment, who is making some amount, who is making some contribution to approved pension fund, then that is also allowed as a deduction to the employer. Again, subject to 43B, I have to make the payment till the due date of filing of return. Plus, there is a cap over here which has been increased by Finance Act 2024. Here there is a maximum cap. Earlier, the cap was the contribution cannot be more than 10% of basic salary plus DA in terms. Now, the contribution has been increased to 14% of basic salary plus DA in terms. I hope it is clear to all of you. Now the employer can contribute up to 14% of basic salary plus DA in terms. I hope it is clear. Similarly, employer, but you have to pay you have to contribute till the due date of filing of return. You cannot do late, subject to 43B. Similarly, 36(1)(5), if an employer contribute to approved gratuity fund, then that is also allowed as deduction. Again, you have to make the contribution till the due date of filing of return. So due date of filing of return, whether it is July or October or November, that you have to check depending upon case to case. But now coming the most important point. What about employees' contribution? I am an employer, you are my employee. Employees' contribution, whatever I deduct from your salary, that is first considered as my income. What it is considered as? It is considered as my income under section 2, clause 24, subclause 10. So whatever employee contribution that I will deduct from your salary, that will be first considered as my income. And then if I want deduction of that, I have to make the payment not till due date of filing of return. I have to make the payment by 15th of the following month. If it is a March salary, I have to make the payment till 15th of April. If it is a Jan salary, I have to make the payment till 15th of Feb. Now for employee contribution, I don't have the time to pay till due date of filing of return. I hope it is clear to all of you. Okay. Next one. Allowance for animals. If I am purchasing any animals other than SIT, I am not buying a stock in trade. I am purchasing animal like an asset, not as a stock. So it is not allowed as a deduction in the year of purchase. So I suppose I purchase an animal for 30,000 rupees. It is not allowed as a deduction in the year of purchase. So when it is allowed? It is allowed as a deduction in the year in which the animals have become useless or they are dead. Suppose after 5 years the animals have become useless. So I am selling that for 5,000 rupees. So cost minus sale value, that will be my deduction. I purchased for 30,000, I am selling for 5,000, differential amount 25,000 will be considered as allowed as deduction to me. Okay, I hope it is clear to all of you. Okay. Next one, very important section, 3617, actual bad debts deduction. 3617, deduction of actual bad debts. Deduction of only actual bad debts is allowed. Deduction of provision for bad debts is not allowed. Provision for bad debts is allowed as deduction under 3617A for certain banks and financial institutions and NBFCs and foreign companies, not to everybody. To majority of the normal business and professional assessee, you will be getting only deduction of actual bad debts. You have to fulfill two conditions. First, you have to write off the debt in the books of accounts. Okay, you have to write off the debt in the books of accounts. Okay, first. Second, you have to take that debt as an income. You have to take that debt as what? As an income. So if you have taken that debt as an income earlier, then only then if you write off that debt, then only it is allowed as a deduction. Otherwise, it is not allowed as a deduction. I hope it is clear to all of you. But for bank and money lending institution, that second condition is not applicable. Suppose I am a bank. If I give a loan of 10 lakh rupees to you, okay, now you are not paying me that 10 lakh rupees loan. So I have to write off that loan. Now, was that loan part of income earlier? No, it's a part of balance sheet. It was never a part of income. So for bank and financial institution, for loan part, for which part? For loan amount, check here. This second condition is not applicable. For bank and financial institution, for their principal amount, for their loan amount, they have to only fulfill the first condition. I hope it is clear to all of you. Okay. Sir, is it necessary to prove that the debt has become bad? Not necessary. There is no need to prove to anybody that the debt has become bad. You have to just write it off in the books of accounts. That's it. No need to prove it to anyone. I hope it is clear to all of you. Next, sir, if the goods are sold by predecessor or amalgamating company and the debt has become bad in the hands of amalgamated company, is it allowed as a reduction? Yes, it is allowed as a reduction as per the Supreme Court judgment of T. Veerabhadra Rao K. Koteshwara Rao. Check it, please. It is allowed as a reduction as per the Supreme Court judgment. Then comes the fourth point, very dangerous point. Sir, there are certain incomes which are not taxable under accounts, but they are taxable under tax. They are not taxable under accounts, but they are taxable under tax because of ICDS. Sir, if such incomes become bad later on, how will we write off that income in the books of account? Listen carefully. 1 lakh rupees I have sold to someone. I have not recorded in the books of accounts because that is not taxable as per books of account. But in the tax, it is taxable as per ICDS. So I have to pay tax on that. Now suppose that has become bad. So the first condition I have to write off in the books. How will I write off that? How will I write off something which is not recorded in the books? So if such income which is not recorded in the books, but it is already recorded in tax, and if that becomes bad later on, then it is deemed to be written off in the books of accounts and you will get the deduction. Don't worry about it. Okay. I hope it is clear to all of you. Okay. Next, 3619. This section is only available to companies, not available to everybody. Only available to companies. This section talks about expenditure on promotion of family planning amongst employees. Expenditure on promotion of family planning amongst employees. If you incur a revenue expense, then it is fully allowed. If you incur a capital expense, then it is allowed 1/5 in 5 equal installment. And because of capital, I have told you earlier also while teaching UAD, because of capital expenditure, if there is an unabsorbed capital expense coming, then it will be treated like what? It will be treated like UAD. Okay? Just like unabsorbed depreciation. This deduction is not available to anybody except company, not available to firm, LLP, individual, HUF. Nobody will get this deduction. This is only for companies. Next, whether I will get a securities transaction tax deduction? Yes. If you are trader in security, then you can claim security transaction tax. Or else under capital gains, you are not going to get the deduction of security transaction tax. If you are an investor in security, you are not going to get the deduction under capital gains for STT. But if you are a trader in security, you can claim. Next. So what about commodity transaction tax? Again, if you are a trader in commodity, you can get the deduction. Next, what about cooperative society, sir? For cooperative society, there is a separate section that if I am a cooperative society, engage in manufacturing of what? Sugar. I am a cooperative society, engage in manufacturing of sugar, and if I want to purchase sugar cane, then I have to purchase at a price equal to or less than the price fixed by the government. If I purchase at more than the price fixed by the government, then I will not be eligible for the deduction. I hope it is clear to all of you. And one last deduction over here under section 36, then we will go ahead with the next part, that is sector-wise deduction, that is deduction for mark-to-market loss. If you are incurring some mark-to-market loss, which loss? Mark-to-market loss, then it is allowed only if it is as per ICDS. If it is not as per ICDS, then it is disallowed as per section 40A subsection 13. I hope it is clear to all of you. So this is where we complete the provisions of section 30, 31, 32 and 36 one. Okay. Now let's go ahead with the next part, and that is a very big part of your PGBP, and that is sector-wise deduction. We are going to talk about all the different sectors one by one, section-wise. Okay. The very first sector is section 33AB, which talks about growing and manufacturing both composite activity of tea, coffee or rubber in India. If you are engaged in growing and manufacturing both of tea, coffee or rubber in India, not outside India, it has to be in India, then you are eligible for this deduction. Now what are you supposed to do? You are just supposed to deposit an amount in NABARD. Okay, then you will get the deduction. By when I should deposit the amount in NABARD? You should deposit the amount in NABARD within 6 months from the end of the financial year. Okay, so financial year ends on 31st March 2025. So you have to deposit till 30th September or before the due date of filing of return, whichever is earlier. Now the most important question, how much deduction I am going to get? You are going to get a deduction of amount deposited compared with 40% of your PGBP income, and your PGBP income should be before this deduction and it should be before setting of the losses. Okay, if there is any brought forward losses, don't reduce that. First take 40% of PGBP and then reduce the losses later on. Okay. Now, whichever is lower, amount deposit, the third point, the quantum is the most important point for us over here. It is the amount deposited or 40% of PGBP income before this deduction and before setting of the losses, whichever is lower, that will be allowed as deduction. Now, the most important thing while solving the sum, how you are going to solve the sum. First of all, they will give you a PGBP income, which is a composite income. The first thing that you will reduce from that is 33AB deduction. Reduce 33AB deduction, whatever amount will come after that, then don't reduce the loss directly. That is where a student will make a mistake. First, PGBP income, a composite income, less deduction to 33AB, you will get an amount. Then don't reduce the loss. Do 40-60, do 35-65. So what is this 40-60, 35-65? Segregate the composite income into taxable and exempt portion. If you are growing and manufacturing tea, in India, then 40% is taxable, 60% is exempt. If you are growing and manufacturing rubber in India, then 35% is taxable, 65% is exempt. So first do 40-60, and then from the taxable portion you have to reduce what? Reduce the losses. This has to be the priority in which you are supposed to solve the sum. In case of coffee, there are two types of coffee. If it is a normal coffee which is grown, etc., then 25% will be taxable, 75% will be exempt. If the coffee is grown, cured, roasted, mixed with kikori and many other activities are done on the coffee, then 40% will be taxable, 60% will be exempt. Okay, so you have to first segregate that, and then it should be subject to what? Reduction of losses from the taxable portion. From the taxable portion, you have to reduce the losses. I hope it is clear to all of you. Now, the amount which I have deposited in the NABARD, can I withdraw that amount or not, sir? Is it allowed for me to withdraw that amount or not? It is allowed for you to withdraw that amount in some circumstances, but in some circumstances, if you withdraw that amount, it is taxable. In some circumstances, if you withdraw that amount, it is exempt. Like for example, you can withdraw that amount in the following circumstances. If there is a closure of business, the business is closed, or if there is a dissolution of firm, then it is taxable. You can withdraw in these two cases, then it is taxable. Yes, if there is a death of an associate, partition of HUF or liquidation of company, then also you can withdraw, but in that case, it is not taxable. It is fully exempt. You can withdraw that money. You can use it for any other purpose. You don't have to pay any tax on that. Okay. Then these are very special cases where most of the cases your business is getting closed. During the business is going on, if I want to withdraw that, can I withdraw that money? Yes, definitely. The first point was in extreme cases where the business is getting closed, or where the business is getting dissolved, or it is getting liquidated, or the associate has died, or the partition of HUF is done. So it's an end of the organization. But if the organization continues, it's a going concern, and if I want to withdraw that, can I withdraw that? Yes, you can withdraw, and then you have to utilize that for specified purpose in the same previous year. You have to withdraw that amount from NABARD. You have to use for certain specified purpose mentioned by the government, and you should use in the same previous year in which you have withdrawn. You cannot withdraw and use in the next year. If it is not utilized in the same year in which it is withdrawn, then it will be deemed income in your hands. It will be taxable. But again, the deemed income will be taxable only to the extent of 40%, 35% and 25%. That is only to the extent of taxable portion and not the entire amount. If I withdraw in case of T, if I withdraw 10 lakh rupees, I don't use for specified purpose in the same year, then only 4 lakh will be taxable, not entire 10 lakh. Okay. Second, if I withdraw the money from NABARD, and if I withdraw the money 10 lakh rupees from NABARD, and if I incur some expenditure like salary, etc., then will I get the deduction of that expenditure also? The answer is no. The deduction of expenditure will not be allowed to you, because that will lead to double benefit of tax. I have told you this already in the class. Okay. So if I withdraw 10 lakh rupees, use it for the purpose of what? Use it for the purpose of incurring some expense like salary, rent, etc., electricity expenses, then that expenditure will not be allowed as deduction. Okay. Next, can I withdraw the money and use it to purchase some assets? Yes, you can purchase some assets, but some assets are prohibited by the government. Don't try to purchase those assets. Which are the prohibited assets? The prohibited assets are plant and machinery which is installed in office, you should not buy that. If you buy that, then it is deemed income. Okay. Residential accommodation equipments, don't buy that. Office appliances equipment, don't buy that. Computer you can buy because it is written not being computer. Therefore, computer you can purchase. It is allowed to purchase the computer. There is nothing wrong in that. But whatever assets you are purchasing which are not prohibited, say, can I purchase land? Yes, you can purchase land. There is no harm in that. But whatever assets you are purchasing, you have to keep that for a period of 8 years from the end of the financial year in which the asset was acquired. So you have to keep it with you for 8 years. If within 8 years, if I sell, then what will happen? Then it will be deemed income. It will be subject to tax. Suppose if I purchase a land of 10 lakh rupees and now I have to hold that land for 8 years. Now within 3 years, I am selling that land. So that 10 lakh rupees will be taxable. How much? Only the taxable portion, 40%, 35% and 25% will be taxable. Along with that, for sale of land, there can be an implication of capital gains also. So I have to bear capital gain tax also for sale of what? Capital asset. But there are some exceptions in which if you sell within 8 years, it is allowed. Like if you sell to government or local authority, it is allowed. Or if there is a succession of a firm to a company, then also it is allowed. There was a firm which is getting converted into a company, and if you are transferring your assets in that case, it is allowed to do that. I hope it is clear to all of you. Okay. So this is what this small section is all about, but it's a very, very, very important section for your examination. Now the next section is a copy paste section. It's an exactly similar section like the previous one. 33 ABA Site Restoration Fund. What are we supposed to do in this case? What is the nature of business over here? Here you are going to prospect, extract or produce petrol or natural gas in India. So you are going to do these things in India. Okay. Now what am I supposed to do? Let's compare this with the previous section directly. In the previous section, we need to go to NABARD. Here, we need to go to what? SBI. We need to go to SBI and deposit an amount. In the previous section, we have time till 6 months from the end of the financial year. Here, we have time before the end of the previous year. I have to deposit the amount by 31st of March. And in the previous section, it was 40% of PGBP. In this section, it is for 20% of PGBP. Only these are the differences. Apart from that, everything is same like the previous section. All these points which are mentioned over here. Point number 1, point number 2, point number 3, point number 4, point number 5. All 5 points are applicable to what? To 33 ABA also. I hope it is clear to all of you. Okay. Now, coming to the next section. Section 35, expenditure on scientific research. Now, what is this section? This section talks about giving benefit to assessees who are engaged in scientific research. Now, they have divided all the sections into 7 categories, and we are going to talk one by one all of them. First, we are going to talk about 35.11 and 1.4. What is 35.11 and 1.4? These two sections are if you are doing scientific research in your business, then it is eligible for you. Scientific research is a part of your business, then you are eligible for these two sections. For whom 35.11 is applicable? 35.11 is for revenue expense, 35.14 is for capital expenditure. So in pre-commencement, if I have done some expenditure, will that be allowed? Yes. Last 3 years before the date of commencement, if today the business is commenced, you can take the expenditure of last 3 years, whatever expenditure you have incurred, you can total all of them, you can claim deduction in the year of commencement. Which expenditures? Pre-commencement salary is allowed excluding perquisite. Perquisites are not allowed. Purchase of raw material is allowed 100%. What about post-commencement? Post-commencement, any expenditure is allowed 100%. No harm in that. No harm, no restriction, nothing is that. So for revenue expenditure, pre-commencement last 3 years, salary excluding perquisites and purchase of raw material. And for post-commencement, all expenditures are allowed. For capital expenditure also 100% deduction will be allowed for pre and post both. But only one expenditure is not allowed, land. Land is not allowed in pre as well as post. Land will not be allowed as deduction neither in pre nor in post. Plus, here also for capital expenditure, last 3 years only expenditure will be allowed. Expenditure incurred beyond 3 years will not be allowed as deduction. I hope it is clear to all of you. Okay. Now, once you claim depreciation, once you claim 100% deduction on capital expenditure, you will not get any kind of depreciation deduction over here. Don't ask for normal depreciation. Don't ask for additional depreciation. The deduction of depreciation is not allowed to you. Yes, but one benefit is there. If because of capital expenditure of scientific research there is a loss, it will be treated just like UAD, which I have told you earlier also while interlinking with what? UAD. So it will be just treated like what? Unabsorbed depreciation. I hope it is clear to all of you. Okay. Now, what about the third section? The third section talks about lot of conditions. Earlier, it was a very big incentive, but now it is similar to the previous two only. So whether you claim deduction under these two or under the third one, it is not going to make a great difference to us. But earlier, this deduction was 200%. At that point of time, there was a differentiating point between the first two section and the third section. But now there is no differentiation. Both of them are same only. Both of them are 100%. But still, it is a different section. In the third section, that is 35 2AB, you need to be a company. Plus, you need to be a company who is engaged in manufacturing of any article or thing other than 11 schedule items. In 11 schedule, there are 29 items which are mentioned by the government. You should not manufacture those. Apart from those 29 items, you manufacture any other thing, or you should be engaged in biotechnology business. Plus, you should do in-house research. You should not outsource the research to anybody else. You should do research yourself. Plus, the research should be approved by prescribed authority. There has to be an agreement with central government. Plus, this section does not give you deduction of building and land. For building, you can go to the previous section. Land, unfortunately, is not allowed. For building, you can go to previous section 3514 and claim 100% deduction. There is no harm. Plus, this section only allows post-commencement deduction. So, for pre-commencement deductions for revenue as well as capital expenditure, you can go to the previous two sections and you can claim over there. Apart from that, all other revenue and capital expenditure will be allowed. But there are a lot of conditions over here. So, it is better you go over here only and claim the deduction rather than coming over here. Okay. I hope it is clear to all of you. Okay. Now, the next four sections are not about doing scientific research, are about giving donation, giving contributions to others who are doing scientific research. 3512, it is you are giving donation to an association, college, university who is engaged in scientific research, you will get 100% deduction. 3513, you are giving again donation to those people who are engaged in statistical or social science research. They are engaged in what? Statistical or social science research. 3528AA, you are giving donation to National Laboratory or Indian Institute of Technology, IIT. And 3512A, the last one, is talking about you are giving donation to Indian companies like Cipla, like Tata Motors, like Infosys, like Wipro, who are engaged in scientific research. So if you give donation to Indian companies, they are also eligible for, the donor will be eligible for 100% deduction. All of them must be approved. All of them must be approved institutions. The government will give them an approval. They have to take an approval from the government that they are eligible for these activities. Okay. Acha. Now, if I gave a donation to somebody and after I gave the donation, the approval is withdrawn after that. Suppose I gave you the donation today and after a few months, the approval is withdrawn by the government that you are doing illegal activity. Whether my donation will be denied, the answer is no. My donation will not be denied. Don't worry. Okay. My donation will be continued to be allowed to me. Next point. Now, the donee has been given to responsibility by the government. Donee has been given to responsibility. Listen carefully. To responsibility. Donee. I am the donor. You are the donee. Donee has been given to responsibility. First, donee has to give a statement to the government of India that who all have given donation to them. So, first requirement is donee has to give a statement to the government of India. Second, donee has to give a certificate to the donor. Donee has to do these two things. If donee does not do these two things, then the donor will not get the deduction check. If the donee does not do these two things, then the deduction will be disallowed in the hands of donor. So donee has to fulfill these two conditions. Further, the donee will also be penalized. First of all, donee will be liable for a fee under 234G of 200 rupees per day. It is not 2000, sorry, just change this. It is 200 rupees per day. For every day 200 rupees, donee will be liable to pay fee. Plus, donee will also be liable for penalty for not doing this. What are the two things that donee has to do? Donee has to deliver a statement and donee has to give what? Donee has to give a certificate. The same requirement is also for ATG institutions. All those who are registered under ATG as a donee, they also have to give a statement to the government and certificate to the donor. So both the people, in both the cases, whether you are a 35, 12, 13, 13A, whether you are Scientific Research Association, Social Science or Statistical Research Association, or whether you are an ATG institution, both of them have to fulfill this condition. If they don't fulfill, the donor will not get the deduction and the donee will not. What? Donee will be liable for a fee of 200 rupees per day and a penalty by AO under 271K of 10,000 rupees to 1 lakh rupees. Okay. I hope it is clear to all of you. Now, coming to last part of scientific research, suppose I bought an asset of scientific research for 100 rupees. For example, okay, I bought a plant and machinery for 100 rupees and then I claim 100% deduction on that. I bought a plant and machinery for 100 rupees, then I claim 100% deduction on that. Okay, under section 35, subsection 1, clause 4. Now, after some years, that machinery is not much useful for me. So what can I do? I have two options. Either I can sell that without using for my business purpose. I can do one thing, I can transfer that to my business division, I can use it for my other business purpose, or I can sell it. If I directly sell without using for business purpose, then I have to pay deemed income on that, and the deemed income will be as per section 41 subsection 3, that is the deduction allowed earlier. How much is the deduction allowed earlier? 100, or the sale price, whatever is the sale price. If sale price is 120 or sale price is 80, whichever is lower, that will be taxable in my hands. And for sale of asset, I have to compute capital gain separately. Okay, capital gains will be computed separately. But one more option which is available with me. What is that another option? That another option is I will not sell that directly from the research division, but I will transfer that for my other business purpose. If I transfer that machinery for my other business purpose, then that machinery will find a place in the block of asset, and in the block of asset, that machinery will be given a place as per explanation 1 to 43.1, but the cost of that machinery will be taken as nil because you have already claimed 100% deduction on that. And whenever you will sell the block of that machinery, because now that machinery is a part of block of asset, whenever you will sell the block of that machinery, you will be liable for capital gains as per section 50. that is short-term capital gains. I hope it is clear to all of you. Okay, so this is what the deduction of scientific research is all about. Now let's go ahead with the next deduction, that is 35 ABB, which talks about amortization of telecom license fees, and 35 ABA, which talks about amortization of spectrum fee paid. The treatment for both of them is same only. That is the reason we are doing both of them together. Now, if you are buying a license before commencement, then you will be given the deduction from the year in which the business commences, but the deduction is allowed only on payment basis. The deduction here is not allowed on accrual basis. You have to pay the deduction, you have to pay the license cost, and then you will take the deduction. If you have paid the license cost, divide by the unexpired life of the license, and it will be allowed to you over the life of the license. As the section itself says, it is an amortization section. You cannot get the deduction in one shot. You will get the deduction over the life of the license. Okay. Similarly, if you have already commenced the business, and now if you are making the payment, then it will be allowed from the year of payment, as and when you have made the payment. Okay, again it will be allowed on a payment basis only. It will not be allowed over an accrual basis. You have to make the payment, take the deduction. Suppose the license is of 1000 crore and you don't have entire money to pay, so and the life of the license is 10 years. Take the example, license is of 1000 crore and the life of the license is 10 years. So you don't have the money to pay the entire 1000 crore in one time. So first year you paid 500 crore, second year you paid 300 crore, and third year you paid 200 crore. Now how will you get the deduction? In the first year you have paid how much? 500 crore. So 500 divided by 10, because from the first year the life is 10 years. So every year you will get 50 crore deduction by default. Second year you paid how much? 300 crore more. So in the second year you will get obviously 50 crore of the first year plus 300 divided by now 9. Okay, and in the third year you will get 200 divided by 8, and from the fourth year the deduction will become consistent. Okay, so this is how you are going to get the deduction of amortization of telecom license fees paid or the spectrum fee paid. The treatment for both of them is same only. Okay, just the section is different. Once you claim the deduction under this section, then no deduction will be allowed as an intangible asset under section 32 for the purpose of depreciation. No depreciation will be allowed on this particular license. Okay, similarly, if you transfer the license later on, then whatever deduction you have claimed earlier, that will be deemed income, along with if you sell the license, obviously there can be a capital gain implication also on you. I hope it is clear to all of you. Okay. Let's move on to the next section, that is section 35D, amortization of preliminary expense. Now what do I mean by preliminary expense? What all things are covered in preliminary expenses, that we will see first of all. What all things are covered in preliminary expense? Preliminary expense includes preparation of feasibility study expenses, preparation of study report, market survey if you are doing something to start a business, then that expense, then engineering services if you are doing some to start a business, that expense, drafting and printing of memorandum of association, articles of association, legal fees if you are incurring, that expense will be covered, expenses relating to public issue of shares and debentures, and other expenses notified by CBDT. There might be some other expenses also which are notified by CBDT, that is also covered in the definition of what? Preliminary expense. Plus one more thing, the expenses which are mentioned in point number A, point number B, and point number C, that is this one, and this one, you have to give a statement for these three expenses. If you want the deduction of these three expenses, that is A to C, the assessee has to furnish a statement of the above expenditure within 1 month prior to the due date of furnishing of return of income under 139(1) to Principal Director General of Income Tax or Director General of Income Tax or any other person authorized in Form 3AF. So for these three expenses, you have to give a statement to the Income Tax Department 1 month prior to the due date of furnishing of return. Only then you will get the deduction, otherwise you are not going to get the deduction. So what I told you just now is what comes in the preliminary expense, and for three expenses you have to give a statement to the Income Tax Department relevant authority. Now, coming back to the section, that this section is only available for Indian companies. It is only available for Indian companies, and if you are not a company, if you are individual, HUF, firm, LLP, then you need to be resident. So this is only for Indian companies and resident, it is not available for others. Secondly, the expenditure should be incurred on specified purpose. What is the specified purpose? That I've already told you, that is the purpose which is mentioned in point number 3 over here. Okay. Now, when should I incur the expense? You can incur the expense before commencement of the business, or you can also incur the expense after commencement of business. But if you incur the expense after commencement of business, then it has to be for expansion of the business, or it has to be for setting up of a new unit. If you incur the expense after commencement, in pre-commencement there is no condition, but in post-commencement there is a condition. If you incur the expense after commencement of business, then your expenditure should be for expansion of business or for setting up of a new unit. It means it has to be for making the business bigger. It should not be for existing business. Okay, then only you will get the deduction. Now the most important question, how much deduction I will get? First of all, you need to find out 5% of your cost of project. Cost of project means cost of all the fixed asset. Then you need to compute 5% of your capital employed. 5% of capital employed means share capital, debenture, long-term borrowing. Whether it share capital will also include premium, share premium? No. As per the Supreme Court judgment of Berger Paint Limited, share premium could not be part of capital employed. Share premium will not be part of your capital employed. Only the paid up capital will be the part of your capital employed. So you should take 5% of the total of your fixed asset cost and 5% of the capital employed, that is share capital, debenture, long-term borrowing. On which date? On which date? On which date? On the last day of the previous year in which both of them should be of the last day of the previous year in which the business is commenced, or last day of the previous year in which the business is expanded. So whenever your business is commenced or where business is expanded, as the case may be, last day of that particular financial year, you have to take 5% of this, 5% of this, and whichever is higher, that will become your point number 1. Then you should compare that with actual expenditure. Okay, whichever is higher, 5% of capital employed or 5% of cost of project, whichever is higher, that will become your point number 1. That you will compare with what? Point number 2, which is your actual expenditure, and then whichever is lower, that will be allowed as deduction, but that too will not be allowed as deduction in one shot. That will be allowed as deduction in 5 equal installment. I hope it is clear to all of you. Is this clear? So let's move on to the next deduction, and that is the biggest deduction of sector wise, and that is investment linked deduction, that is section 35 AD. First of all, we need to understand the nature of businesses which are covered over here. There are in all 14 businesses which are covered over here. We need to understand all of them. You don't need to by heart all of them. Just try to just go through it once and just keep it in your conscious mind. Okay, you need not have to by heart in the order. First one is cold chain facility for certain agricultural products. Second is warehousing for agricultural products. Hospital of at least 100 bed housing project for affordable housing. Then production of fertilizer, cross country natural gas, crude, petroleum, oil pipeline. Building and operating a hotel of 2-star and above category. Now this word building and operating is very important. If we are going to link that in some time with some other concept. Housing project for slum redevelopment. Here the housing was for affordable housing. Here the housing is for slum redevelopment. There is a difference in the treatment of both of them. Inland container depot, container freight station, beekeeping, production of honey, beeswax, warehousing for sugar, and then laying and operating a slurry pipeline for transportation of iron ore, semiconductor wafer fabrication manufacturing unit, and last but not least, infrastructure facility. An infrastructure facility, earlier infrastructure facility was covered under ATIA. Now it has been shifted to 35 AD. Infrastructure facility includes what? Includes toll road, bridge, rail system, highway project, housing project, which is an integral part of highway project, water supply treatment, water treatment, irrigation, solid waste management, sewerage system, port, airport, inland waterway, inland port. Okay, all these things are there in the 14 businesses. If you are engaged in any of the 14 business, you are going to enjoy some great deductions under section 35 AD. What is that deduction? That we are going to talk in a while in next 2 minutes. Before that, 1 or 2 small issues are there which I would like to address. Suppose there is one case law with respect to an hotel. With respect to an hotel, there is one case law. The hotel has to be of what? 2-star or above category. So who will give the star category? It is the central government who will give you star, whether you are 2-star or 3-star or 4-star or 5-star or no star. Okay. So for that we need to make an application to central government. Suppose I made an application to central government in this year, but the government gave an approval in the next year. The government approved me as a 5-star hotel or 3-star hotel in the next year. So the issue which came in front of the court was whether I will enjoy the deduction from the next year or I will enjoy the deduction from the year of application. So the court has held that you will enjoy the deduction from the year of application. Don't worry about it. Okay. So you will enjoy the deduction from the year of application and not on the year in which your application is approved. Similarly, one more point you need to keep it in mind, that 6th business and the 14th business, that is the 6th business is of cross country pipeline and 14th business is of infrastructure facility, which I generally tell as Adani and Ambani's business. 6th business is done by Ambani and 14th business is done by Adani, most of the places in this country. So these 2 businesses are only allowed to Indian company or consortium of Indian company. Consortium means joint venture of Indian companies. It is not available for all the persons in general. Okay, it is only available to these 2 category of people. That is, you need to be Indian company or consortium of Indian company. Now coming to the most important part, how much deduction available to me? How much deduction will be allowed if you are engaged in any of the 14 business? You will get 100% of your capital expenditure over here. Revenue expenditures are not covered over here, but revenue expenditure anyways you get deduction 100% only. You will get 100% of capital expenditure also. That is a big benefit to you. And revenue expenditure everybody gets 100%. Therefore, here also sir, there is a pre-commencement, post-commencement. Yes, pre-commencement deduction is allowed, post-commencement deduction is allowed. For pre-commencement, there is no time limit of 3 years also, unlike the scientific research deduction where there is a 3 years time limit limit. Here there is no time limit. Even if the expenditure is 5-year-old, you will get the deduction. Okay. So therefore, you will get 100% deduction of pre-commencement over here. But only condition for taking pre-commencement deduction is your expenditure should be capitalized in the books of accounts on the date of commencement. If you do that, you will get the deduction. For post-commencement also, you will get all the expenditure of capital nature except 3 expenditure which are neither allowed in pre nor in post. 3 expenditures are not allowed. That is land, goodwill and financial instrument. If you incur these 3 expenditures will not be allowed to you under section 3580. Plus any other expenditure, plant, machinery, furniture, building, everything will be allowed. But here also there is a condition of that 10,000 rupees. If you make a payment to a person in a day of more than 10,000 rupees, then you should make the payment by 4 modes: account pay check, account pay draft, ECS or such other electronic mode as prescribed by the government. Otherwise, you are not going to get the deduction under section 3580, just like we do not get deduction of depreciation under section 43(1) in the definition of actual cost. I hope it is clear to all of you. Now the next conditions are multiple places it is applicable. This condition is also applicable in 10AA. It is also applicable in special regime, special tax regime under 115 BAB and BAE. Now what is this condition? There are 3 conditions which are mentioned by the government over here. First, your business should not be formed by splitting up or reconstruction of an already existing business. It means your business should be an existing, should be a new business. It should not be an existing business. It should not be by acquiring somebody else. It should not be by amalgamating somebody else or demerging somebody else. Then it is not allowed. It has to be a new business. Second, second-hand plant and machinery is not allowed in your business. Your business should not have second-hand plant and machinery. But for this condition, there are 2 exceptions where second-hand plant and machinery is allowed. If second-hand plant and machinery is up to 20% of total value, it is allowed. Further, if second-hand plant and machinery is imported second-hand plant and machinery, then also it is allowed, provided no depreciation is taken earlier. So here imported second-hand plant and machinery is allowed, but under additional depreciation in imported second-hand plant and machinery is also not allowed. Okay, here it is allowed, but in additional depreciation it is not allowed. Be very careful. Now, once you claim a deduction under this section, then you cannot claim any deduction under 10AA. Either you claim 3580 or 10AA. You cannot claim both of them together. You cannot claim chapter 6A. You cannot claim section 32 normal depreciation, additional depreciation. Already you have claimed 100% of your capital expenditure. Now by what phase you will ask for depreciation or additional depreciation? Once again, it will be duplication of the same expense. Okay. Now hotel industry has a special benefit. Hotel industry has been given a special benefit. Hotel industry runs on a concept of franchise. Now the law says that the assessee should build the hotel and operate the hotel. Now everything cannot be done by assessee. I will build the hotel, but I will give the operations to somebody else as a franchise. So in that case, whether I will continue to get the deduction or not, the government has said yes. If you are a hotel industry and if you build the hotel and if you transfer the operations to somebody else but continue to own the hotel, then you will be eligible for deduction under 3580. Check it please. There is no need to do both building and operating both the things by the assessee. Operations can be given to somebody else. It is allowed. Next, sir, if there is a loss under 3580 business, obviously if you take so much 100% deduction of capital expenditure of plant, machinery, furniture, building, there are bound to be losses in your business. So if there are losses, sir, how will I claim the loss? Whether it will be allowed like UAD? No. It will not be allowed like UAD, but it will be having a separate section 73A which says that losses of 3580 business can be set off against any other 3580 business for infinite number of years. So all 14 businesses you can set off against each other, but you cannot set off against other businesses. Okay. If you have a coaching class business, you cannot set off a 3580 loss against a coaching classes business. I hope it is clear to all of you. And this loss can be carried forward and set off for how many years? It can be carried forward and set off for infinite number of years. There is no restriction in number of years. I hope it is clear to all of you. Now, last but not least, but very important part of this section, that is deemed income part. So what is the deemed income concept in this particular section? Let me explain you the deemed income part of this particular section. If an asset is there on which you have claimed 3580 deduction, for example, you have purchased a building on which you have claimed 100% deduction. Okay. Then later on, if that asset is demolished, condition number 1, or destroyed, condition number 2, or discarded, condition number 3, or transferred, condition number 4, then whatever amount will be received, that will be chargeable as a deemed income and in your hands as per section 28. This is a special charging section. If the asset on which deduction is claimed is discarded, demolished, destroyed, or transferred, then whatever amount you will receive, you have to pay tax on that. Even after 10 years, 15 years, 20 years, 30 years, 40 years, 50 years, there is no time limit over here. Be very careful. But the second deemed income is if you purchase an asset, say 100 crore rupees asset you have purchased, and if you use that asset for any other business for 8 years, you have a lock-in of 8 years. You cannot use that business for other purpose for 8 years. If you use that asset for other purpose for 8 years, then the deemed income will be as follows. How? Whatever deduction you have claimed earlier, in my example 100 crore minus minus the depreciation for those many years for which you have used the asset for normally. Okay, so I purchased the asset today for 100 crore. For 2 years I use properly. After 2 years I am making misuse of that asset. So 2 years depreciation and additional depreciation, if applicable, you have to reduce from here. Whatever amount will come, that will become your deemed income. And later on, that asset is free now. You can use that asset for any purpose now, because once you have borne the burden of deemed income, then that asset is free. Later on, this amount, which is the deemed income, that will become the actual cost for you for other business and profession for which the asset is used, and you can claim depreciation on that amount. Okay, so again I am saying 100 crore asset I purchase, I claim 100 crore deduction under 3580. Then after 2 years I am misusing the asset, so 100 crore minus 2 years depreciation, that will become deemed income. I have to pay tax on that immediately, and then later on, that whatever is the deemed income, that will become the actual cost for my other business for which I can claim depreciation. But this deemed income is not applicable if an assessee is a sick unit. If you become sick unit as per the Sick Industrial Companies Act, then this provision is not applicable to you. I hope it is clear to all of you. So let's move on to the next section, that is section 35E, which is applicable if you are engaged in taxation of mining of coal, limestone, iron ore, etc. Now this section, just like 35D, is only applicable to Indian company or if you are resident. If you are non-resident, then this section is not applicable. Okay. Now what should I be engaged into? What should be my business? My business should be of prospecting, extraction, production of minerals like coal, limestone, iron ore, gold, zinc, etc. So if I am engaged in all these businesses, I will be eligible for deduction under this section. What expense I should incur? I should incur an expense for prospecting of minerals. Prospecting means finding out of the minerals, researching of the minerals, try to identify whether minerals will be available under this land or not. Okay, on that you need to incur some expenses. Those expenses are covered over here. Or if you are incurring some expenses on development of mines, then that is allowed. Okay. When should I incur the expense? You should incur the expense in the year in which you are commercially exploiting the mineral, commercially exploiting the mine, and the last 4 years. Suppose in 24-25, I am starting to explore the mine and earn revenue out of it. So that is considered to be the year of commercial exploitation. So the expenditure should be incurred in the year of commercial exploitation and the last 4 years. Okay, that is the year in which you should incur the expense. And the expense, whatever expense you will incur from that, if there is any subsidy or some amount is provided by the government. Suppose in the year of commercial exploitation and in the last 4 years, I have incurred 10 lakh rupees, and out of that 50,000 is supported, it is helped by the government of India. So that much I will reduce. Therefore, the amount will come to how much? 9,50,000. Now this 9,50,000 will be allowed to me over how many years? Over 10 years. Okay, this will be allowed to me over 10 years from the year of commercial exploitation. Now this 9,50,000 divided by 10 comes to how much? 95,000. This 95,000 I can set off against what? I can set off against income of all the mines. Not only this mine. If I have income from any other mine, then I can set off that against that mine also. And if there is any balance left, I can carry forward up to 10th year. For example, 9,50,000 is my total qualifying expenditure. Divide by 10 will come to 95,000 rupees. Okay. Now, this mine is giving me 40,000 rupees revenue, income, and another mine is giving me 30,000 income. So therefore, total income is how much? 70,000 from different mines, but my expenditure itself is 95,000 rupees. So you can claim 70,000 in the current year and balance 25,000 you can claim in the next year. So in the next year you can claim 95,000 of next year and 25,000 of the first year. So in the next year you can claim both of them. Till 10th year you can do that. Okay. Now the expenditure will not include any capital expenditure, like if you acquire some mine or site or building, plant, machinery, furniture on which you are claiming depreciation. So such kind of expenditures will not be covered under this section. Okay. For that you are already claiming depreciation. So continue to do that. Okay. Now coming to the next section, which is very, very, very important. The previous one, this one was not that important, 35E, but this is important one, 3617A, provision for bad and doubtful debts. That is provision for reserves and doubtful debt, which is applicable to certain banking industry. So if you are a scheduled bank or non-scheduled bank or cooperative bank, then the treatment is different. And if you are a public financial institution, state financial corporation, foreign bank or NBFC, then the deduction is different. So for scheduled bank, etc., for cooperative bank, the deduction is higher. How much? 8.5% of the gross total income. What? 8.5% of the gross total income plus 10% of the aggregate advances made by rural branches. So SBI has so many branches, but out of that only take the rural branches and take 10% of the rural branches advances given by the SBI. You will get both the deduction if you are a scheduled bank, if you are a non-scheduled bank, or if you are a cooperative bank. But if you are a public financial institution, foreign bank or NBFC, you are only going to get 5% of the GTI. The second one is not allowed. Sir, will we also get the actual bad debt deduction? actual bad debts deduction will be allowed if your actual bad debts is more than your provision for bad debts. Suppose if your provision for bad debts is 100 rupees and if your actual bad debts is 180 rupees, then you will get 80 rupees as your deduction. Now when you compare your actual bad debts with provision for bad debts, you have to compare your actual bad debts with the opening provision as well as the current year provision. Suppose opening provision for bad debts is 100 and current year provision for bad debts is 50. So you have to compare your actual bad debts with 150 rupees and not only with the current year provision. Be very careful. That is where majority of the students make a mistake. Okay. Now coming to the next section, that is transfer to special reserve. If you transfer your profit to a special reserve, you will be eligible for some deduction under section 36(1)(8). Who is eligible for that? Banks are eligible, public financial institutions are eligible, who are giving long-term finance. Long-term finance for four purpose, either for industrial purpose or agriculture purpose or housing purpose or infrastructure purpose. So if I am bank or financial institution, if I am giving loan, long-term loan for these four purposes, I am eligible for deduction under section 36(1)(8). I have to just transfer an amount to a special reserve and I will get the deduction. So how much deduction I will get? Whatever amount you have transferred, point number 1, compare with 20% of profits from above business. Above business means from giving loan, not all businesses, only from the profit of above business, that is from the profit of money lending business. Okay, not other businesses. Take 20% of that and then compare that with 200% of paid up capital and general reserve on the last day of the previous year, that is on 31st March 2025, minus you have to take special reserve account on the first day of the previous year, that is 1st April 2024. So take 200% of paid up capital and general reserve on the last day minus your special reserve account on the first day, then whichever is lower will be allowed as deduction. Now whatever amount you have transferred to the special reserve account and you have taken that as a deduction, then you cannot transfer back that to P&L. If you withdraw that money from the special reserve account, then it will be deemed income under section 41(4)(a). Check it please. So you cannot withdraw that back in your special reserve account, in your P&L account. If you withdraw that back, then you have to pay tax on that. Okay, I hope it is clear. It is as simple as that. Now last few miscellaneous deductions which are not falling anywhere, so we have put that as a miscellaneous deduction and we are going to conclude now all our specific deduction. After this we are going to go ahead with what? With the general deduction under section 37(1). Now small deductions are there. 35 CCA. If you incur some expenses for what? For rural development. So if you are making payment to any institution or association for what? Who are engaged in rural development, who are helping rural people, etc. Okay, then you will get deduction over here. Next, 35DD. If you are incurring amalgamation or demerger expenses, then you are eligible for deduction over here. But this deduction is only available to Indian companies. It is not available to foreign companies. It is not available to others. So if you are an Indian company, you will get deduction of amalgamation and demerger expense. Then plus you will also get the deduction for not in 1 year but over the 5 years. That is, it will be amortized over 5 years, just like 35D preliminary expense. 35DDA. If you incur some expenses for what? VRS, voluntary retirement expense, then that is also allowed over 5 equal installment. It will also not be allowed in one single year. It will be allowed in the 5 years. Okay. Then 35CCC, expenditure on agriculture extension project. What is this, sir? If you help for agriculture purpose, if you help the farmers to improve their agricultural activity, if you explain the farmers that how agriculture can be improved with the help of technology, and if you incur expenses on that, you will get 100% deduction over here. And last but not least, the last section over here, 35CCD, is only available to companies. It is not available to others. It is only available to companies. It is on skill development. If you incur some expense on skill development, that is on training of your employees, etc., then you will be eligible for deduction. But it is only available to company, not available to others. Plus land and building will not be allowed as deduction under this section. Check it please. Okay, I hope it is clear to all of you. So this is where we complete all the sector wise deduction, all the specific deduction from 30 to 36. Now the next target would be to go ahead with general deduction. And before going ahead with general deduction of expenses, I would like to say a few things about losses. Whether losses are allowed under income tax law as a deduction or not. Definitely. If the losses are of trading nature and which are incidental to the operations of the business, they will be allowed. Capital losses won't be allowed. Trading losses will be allowed to you. Don't worry about it. Okay. Now coming to the general deduction of expense. Because 37(1) is not about losses. 37(1) is only about expenses. Therefore, we have to talk about losses first and then we have to go ahead with what? With the expenses. Let's talk about the general deduction of the expenses. If you want deduction under 37(1), then you have to fulfill 4 conditions. 3 negative conditions, 1 positive condition. Which are the 3 negative conditions? First, the expenditure should not be mentioned in 30 to 36. The expenditure should not be personal. The expenditure should not be capital. 3 negative conditions. And 1, the expenditure should be incurred wholly and exclusively for the purpose of business and profession. 1 positive condition. So 3 negative condition, 1 positive condition, if you fulfill, you can come under 37.1. But wait, there are some explanations also attached over here. There are some circulars attached over here. There are some Supreme Court, High Court judgments attached over here. You have to look at all of them and then take a decision whether an expenditure will be allowed under 37.1 or it will not be allowed under 37.1. Okay, be very careful. So first, there is an explanation attached over here. If you incur any expense which is illegal, then it will not be allowed. Illegal expenses will not be allowed. If you incur any expense for an offense which is prohibited by any law, then that expenditure will not be allowed. I am incurring some expenses which are prohibited by law, which is an offense under any law, then it will not be allowed. Which law? Indian law or outside India law? Both the law. If I break an Indian law and for that I incur an expense, or if I break a foreign law, for that if I incur an expense, both are disallowed under the income tax law. Second point have come for doctors and pharmaceutical company. If I am a pharma company and you are a doctor, and if I am giving you freebies and telling you please sell my medicine only, don't sell others medicine, then it is bad in law. You're not allowed to accept that. And if you still accept that, and if I give you that particular benefit to you, then that benefit is not considered to be an allowable expenditure in my hand. It will be disallowed under the income tax law. Third one, if I do any compounding of an offense, whether I compound that offense in India or outside India, if I compound any offense under Indian law or under a foreign law, both will be disallowed under the income tax law. What do I mean by compounding of an offense? Compounding of an offense means you have broken a law. Now you are trying to cover up that law by paying some hefty fee, hefty penalty. Then that is also disallowed under the income tax law. Be very careful. Okay. Next one, last one is an amendment made by Finance Act 2024. For a long time, no amendments have been coming. There are very few amendments in PGBP. Most of the amendments are in assessment and capital gains only. PGBP, there are not much amendment. So what is this amendment? If you incur expense to settle proceedings initiated in relation to contravention under such law as may be notified by central government. So central government will notify a few law, and in that law, if you are violating any provision, and to settle that particular thing, if you are making some payment to the government to settle that proceeding, so that settlement amount which you are going to pay, that will also not be allowed to you under the income tax law. Now, which laws are there, sir? I don't know. The government is going to notify those laws. They have not notified so far. So whenever they will notify, at that point of time, I will be able to say, as of now, I don't know which laws are there. Are you clear? So as of now, I can only explain you the entire approach of this particular section, why this particular point has been put, that there are some laws in which if you make any mistake, you can go to the government, settle with them, make a payment for settlement fee, and whatever settlement fee you will pay, that will be disallowed under the income tax law. I hope it is clear to all of you. Next one, I have already told you that if a pharmaceutical company give freebies to the doctor, that is disallowed. That is bad in law. It is bad in law as per the income tax law. Similarly, if a diagnostic center gives some commission to the doctors and tell the doctors that please send all your patients to my laboratory only for testing, for what? For CT scan, for sonography, and for X-ray, etc. And I will give you commission. So that commission is also bad in law. It is not a good practice. It is not a fair practice. That will be disallowed under the income tax law. I hope it is clear to all of you. Now let's move on to explanation 2 to 37.1. Explanation 2 to 37.1 talks about if you incur expenses in relation to corporate social responsibility, which is mentioned under section 135 of Companies Act. It is not allowed as a reduction, not allowed as a reduction, not allowed as a reduction. CSR expenses are not allowed as a reduction. So whether donation to PM Care Fund is allowed. Donation to PM Care Fund is allowed under ATG. Okay, it is allowed under ATG, even if it is CSR. PM Relief Fund is also allowed under ATG, even if it is CSR. That is allowed. These two CSRs are allowed under ATG. However, donation for Clean Ganga, Swachh Bharat Kosh not allowed, even if it is CSR. So if you make a payment for donation for Clean Ganga or Swachh Bharat Kosh, it is not allowed if it is expended as what? As a CSR. If you are not incurring that as a CSR, then it is allowed. But if you are treating that as a CSR, then it is not allowed under the income tax law. All other expenses which are otherwise allowable will be allowed under the income tax law. Okay, now what do I mean by this? Suppose if I make a donation to IIT, then that is also considered as a CSR. So that is not allowed under 37.1. Now that is allowed under 35.1.1, 1.2, 1.2a, 1.3, 2AA, etc. So those will be allowed as deduction. Don't worry about it. Okay. So if an expenditure which is considered as CSR, and if you wish to claim that under 37.1, then it will be disallowed. So CSR, if you are classifying them under 37.1, then that will be disallowed under the income tax law. So what is the treatment of penalties? See, it is wrong to say that penalties are disallowed. You need to check the nature of the penalty. If the penalty is penal in nature, penal means it is for breaking a law, it is for infraction of a law, then it is disallowed. But if the penalty is compensatory in nature, then it is allowed. What do I mean by compensatory penalty? Suppose we are entering into a contract and I made some delay in fulfilling my commitment. So I am making you some compensation. That is in the nature of penalty. I did not supply the raw material on time to you. So I am making you payment some compensation. I did not complete your batch on time, so I'm making some payment as a compensation, just for the sake of joking. I'm not saying reality. I'm not saying I'm not paying any compensation to you. But in case if I pay you, then that will be compensatory in nature. That is allowed under income tax law. Okay. Now, so what about interest of income tax law? Interest of income tax law not allowed. What about penalty under income tax law? Not allowed. What about interest of GST? Interest of GST allowed. What about penalty of GST? Penalty of GST is not allowed. So for direct tax and indirect tax, both penalties are not allowed. Let me tell you very clearly. For GST, interest is allowed. For GST, penalty is not allowed. For income tax, interest and penalty both are not allowed. I hope it is clear to all of you. So what about premium of keyman insurance policy? If a keyman insurance policy premium is paid by a company, it is allowed. But what about if it is paid by firm for partners? I am a partnership firm. I am making a payment of keyman insurance policy for my partners. Whether that is allowed? That is allowed only under one circumstance as per CVD circular, if that partner is very important for the firm. If that partner is not there, then the business will be disrupted. Then it is allowed that you take a keyman insurance policy for that particular partner. Then it is allowed. Otherwise, it is not allowed. Okay. Dr. T.A. Qureshi. Dr. T.A. Qureshi case law, very legendary case law, very landmark case law, unfortunately, which I have told you in the class, that whether the losses of illegal nature are allowed or not. Yes, losses of illegal nature are allowed under section 37, are allowed under the income tax law, because losses are not covered under explanation 1 to 37.1. Losses are not covered here. What is covered here is only expenses, expenses, expenses. Therefore, if there are any illegal losses, that will be allowed as an expenditure to you. Don't worry. Okay, I hope it is clear to all of you. Next, if I do any advertisement in a brochure of a political party, is that allowed? The answer is no. That is not allowed as a business expense. But if you are an Indian company, then advertisement in a brochure of a political party is allowed as a deduction, as a donation under 80 GGB. I hope it is clear to all of you. But by default, advertisement in a brochure of a political party is not allowed as deduction. I hope it is clear to all of you. Is it clear? Let's go ahead. Clarification of build, operate and transfer project, which is called as BOT project. What happens in BOT project? You are government, I am a private player. You will give me a land and you will tell me to develop road on that, bridge on that, and for 10, 15, 20 years I will enjoy that road, I will maintain that road, I will operate that road, I will construct that road, and I will earn the revenue out of it in the form of toll, etc. So whatever expenditure I have incurred, and after 10, 15, 20 years I will give back the land to you. The land belongs to the government only, it does not belong to me. So in case of build, operate, transfer project, I will operate, and then I will transfer to the government. So the expenditure will be allowed. Whatever expenses I have incurred on making that road, making that highway, making that bridge, whatever is the construction cost of that particular project, that will be allowed over the life of the agreement. Okay. If the agreement between the SSC and the government is for 20 years, then the expenditure will be allowed for 20 years. Okay. Next, some small case laws. Shanti Bhushan versus CIT. Whether an expenditure incurred for heart surgery can be allowed as deduction? The answer is no. This can neither be allowed under section 31 nor under 37.1. Okay. Similarly, if an amount which is paid as a compounding fee for what? For breaking a law. The Karnataka government has allowed me to make a building of 7 floors, but I have made a building of 8 floors. So now I'm making compounding fee. Whether that will be allowed as deduction? No, it is a penalty, and therefore it is not eligible for deduction. I hope it is clear to all of you. Next, Neelavati and others. Whether if I make a payment to police or gundas as a bribe to keep that antisocial elements away from my theatre, whether that will be allowed as deduction? The answer is no. It is bribe. It is bad in law. You cannot do that. Okay. So these are small case laws. I will address all of them. The way I have told you at the beginning, the revision videos are going to be very comprehensive. Each and every point from the book will be revised. Nothing will be left. Don't worry about it. Okay. Nothing will be left, and everything will be revised in full English for you all. I will take double efforts for you all. It's not that easy to revise the same thing once in Hindi, once in English. It's a very, very tedious task. It's a very difficult task. My throat goes on a toss, but I will give my best for you all. For my South Indian students who don't understand who don't understand Hindi, unfortunately. Okay, I'll give my best. Don't worry for you all. But you need to have some patience. And you need to spread this particular video to, like COVID-19, amongst all your friends in South India who need to learn direct tax in English. Okay, you can do that much for me. If yes, please comment below. And please comment below and let me know how is the video. Please comment below and let me know what improvement I can do in my revision videos. I'm always ready to learn from you all. Okay, you are my best teachers. Let me go ahead. Orient Ceramic and Industries Limited. What does this case law say? I'm putting one glow signboard outside my shop. Whether that will be allowed as deduction? Yes, it is allowed as deduction. The court said that a glow signboard outside the shop is a revenue expense. Why? Because it has a very short life. It replaces very frequently. It does not bring into existence any asset. There is no enduring benefit. Enduring benefit with benefit for a very long period of time. Therefore, it should be allowed as a deduction. There is nothing wrong in that. Is it clear? Next one is a very important case law. I am a company. I am raising some funds from the investors in the form of share application money. I am putting that share application money in the bank. From that, I'm getting some interest. Whether that interest will be chargeable as IFOS? No. The court has said that that interest should be set off against the public issue expenses. Check, please. That interest should not be considered as an IFOS income. That interest should be set off against what? Against the public issue expense. Whatever are the share issue expenses, against that interest will be what? Set off. I hope it is clear to all of you. Next one, which is the case law of PVR, Priya Village Roadshow. The assessee incurred some expenditure on feasibility study, but the project did not work. So the project is abandoned. So whether that expenditure will be allowed as a revenue expense or not. So assessee was doing some feasibility study for starting with a new theatre, but the project did not work. The project was abandoned. Whether that expenditure on feasibility study will be allowed? The answer is yes. Delhi High Court has said that yes, you will be allowed a deduction. And last but not least, National Cooperative Development Corporation Limited. This case law talks about a very important aspect. To claim deduction under 37(1), is it important to see the source of income? Whether the source is taxable source or exempt source. Based on that, 37(1) will be allowed? The answer is no. 37(1) has nothing to do with the source of fund. 37(1) talks about 4 conditions. You have to fulfill those 4 conditions. That's it. You need not have to see the what? Source of the fund. I hope it is clear to all of you. Is it clear? I hope it is clear. Now, after that, I have put some more expenses over here, which will be very important for you all in examination. It will be in the form of adjustments in your sums. Like dividend. Dividend is not allowed as deduction. Obviously, dividend is what? Is an appropriation of profit. It is not an expense, not allowed as deduction. Income tax not allowed, wealth tax not allowed, surcharge not allowed, health and education cess not allowed. Provision for loss of subsidiary not allowed. Deferred tax expenditure not allowed. It is an income tax only. Provision for diminution of value of investment not allowed because it's a capital loss. Provision for uncertain liability not allowed because it's a contingent liability. Prior period expenses by default it is not allowed. By default prior period expenses are not allowed under income tax law, but if the liability to pay that prior period expense is crystallized in the current year. Earlier, I was not aware that I have to pay this expense. In the current year, I came to know that I have to pay this because the court has passed some order, etc., that you have to pay this much amount to the employee. So current year, I came to know that this is a liability which is exercised in the, which is crystallized in the current year. Then it is allowed. Then it is allowed. Okay. Retrenchment compensation. It depends upon you are retrenching your employees because of what? If the entire business is closed, and because of which you are removing your employees and paying retrenchment compensation, it is not allowed. It is a capital expense. If the part of the business is closed, if one of the unit is closed, and for that you are incurring what? Retrenchment expenses, then that is allowed. I hope it is clear to all of you. Is it clear? What about share debentures issue expenses? If you incur expenses for IPO, FPO, right shares, then it is a capital expenditure, then it is not allowed. It is not allowed because in this case you are going to permanently raise capital in your business. That money will be helpful for you throughout your life. That is not allowed. If you incur expense for buyback, bonus, debentures, loans, etc., this does not change your capital in the balance sheet. Therefore, it is allowed. It does not change your permanent capital in the balance sheet. It is not going to give you permanent benefit. It's a temporary benefit. Therefore, the expenditure on these things will be allowed as deduction. Last but not least, registration fees for increasing authorized capital, that is not allowed because again, the intention is to increase the permanent capital of the company. Therefore, it is not allowed. I hope it is clear to all of you. Here we complete all the deductions under the income tax law, including the general deduction. So now let's move on to the next part, and that is disallowances. Disallowances are divided into 2 parts. One is section 40 capital A disallowances, another is section 40 small a disallowances. Let's talk about section 40 capital A disallowances first. In this section 40A subsection 2, you are supposed to not pay excess to your related party. If you make excess payment to related party, then the excess will be disallowed, not the entire amount. Okay. So if there are certain specified person, and if you make them payment unreasonable payment, you are making excessive payment, you are making them payment more than the fair market value, you are making them payment more than the legitimate needs of the business, then the AO, the assessing officer, may disallow your excess amount. Only excess is disallowed, not fully disallowed. So to whom I should not make excess payment? Specified person. Who are specified person? Certain related party. Who are related party? The definition is below. Let's see. If I am an individual, then who is specified person for me? My spouse is specified person, my brother, sister, my lineal ascendant and descendant. Lineal ascendant and descendant means my parents, my grandparents, my children, my grandchildren. All of them are lineal ascendant and descendant. Who are my family? Who is above me? Who is below me? So if I make payment, if an individual make payment to these people, they should not make payment more than the fair market value. You should not make excessive payment. Okay. Similarly, for HUF, who is the related party? Member is the related party for HUF. And the relatives of member is also related party for HUF. So Karta's sister will also be related party for HUF. Karta's mother will also be related party for HUF. Karta's wife will also be related party for HUF. For firm, the partner is a related party and the relatives is also related for the firm and LLP. Same is the case with company director. For company, Mukesh Ambani is a related party. And Nita Ambani, wife of Mukesh Ambani ji, is also related party for the company. Children of Mukesh Ambani ji is also related party for the company. Okay. So you cannot make excess payment to all of them. And for AOP, BOI also same, members and their relatives. Okay, I hope it is clear. And assessee having substantial interest in any entity. Suppose there is a company in which the assessee is having substantial interest. Substantial interest means I am having 20% or more stake in any company. Then also that entity will be called as related entity, related party, and holding subsidiaries will also be called as what? Related party. Check it please. If we are holding subsidiary, then also we are what? We are related party. I hope it is clear to all of you. Is it clear? Now coming to one last point over here. This section is only applicable for excess expenditure. It is not applicable for excess income. If I am a company, you are a director. Okay, if a company is selling something to a director at a lower price, then this section is not applicable. Suppose the market value of a product is 1 lakh, but I am selling to the director for 20,000 rupees. This section is not applicable because this section is only applicable for expenses. It is not applicable for receipts or incomes. Okay, this is what it is mentioned over here. I hope it is clear to all of you. Okay. Now let's move on to the next section, which is similar to what we have done earlier, 40A3. But this is only for revenue expense. Earlier we have done with respect to 35 AD and with respect to depreciation, that was capital expenditure. If you make any revenue expense and if you make the payment to one person in a day for more than 10,000 rupees, then you have to make the payment by 4 modes: account pay check, account pay draft, ECS, or such other electronic mode as prescribed by the government. Which are the electronic modes which are prescribed by the government, which you are saying again and again, sir? Let's see. Credit card is prescribed, debit card is prescribed, net banking is prescribed, IMPS, UPI, RTGS, NEFT and BHIM. These are the 8 modes which are prescribed by the government. Along with that, account pay check is okay, account pay draft is okay, and ECS is okay, electronic clearing system. Bearer check not allowed, cross check not allowed, account pay check has to be there. If you are making payment of more than 10,000 to one person in a day, okay. For transporter, the limit is how much? 35,000. Now, suppose if you have incurred the expenditure in the current year on accrual basis, suppose salary to outstanding salary 50,000 rupees, I have pass this journal entry, I claim the deduction also, and next year if I make the payment to one person in a day in cash of 50,000 rupees, then it will be deemed income of the next year. Check it please. Okay, then it will become deemed income of the next year. So if you incur the expenditure in the current year and claim deduction on accrual basis, and in the next year if you do what? If you make the violation of 40A3, then it will be deemed income of the next year. I hope it is clear to all of you. Now, there is a rule 6DD which talks about certain exceptions where you can make the payment as much payment as you want in cash. First, if you make the payment to RBI, LIC, bank or government, you can make as much payment as you want in cash. There is no restriction. Second, if you make the payment by book entry, what do I mean by book entry? You are debtor, I am creditor, so I am making some payment, you are making some payment. Instead of that, we are netting of the transaction in the books of accounts. Okay, debtor, creditor are internally netting of the transaction. Rather than paying each other, we are setting off the amount. So that is known as payment by book entry and that is allowed. Next, if you make the payment to producer of what? Agricultural product, it is allowed. If you make the payment to producer of what? Forest product, it is allowed. If you make the payment to producer, these people have to be the producer of these products. Poultry products allowed, dairy products allowed, fish products allowed, livestock allowed. So there was one question which was raised with respect to fish products. Who are producer of fish product? So the CBDT has clarified that fisherman is the producer of fish product, or the headman of the fisherman who sorts the catch. All those who catch the fish, those people are called as what? Fisherman. And therefore fisherman, if you directly buy from the fisherman, then rule 6DD is applied, and if rule 6DD is applied, you can make the payment in cash. There is nothing wrong in that. You can make the payment in cash. It is allowed. And one more question was raised in case of fish and fish product. What does fish and fish product include? Because fish and fish product, marine products include lot of items. So the government has said that fish and fish product would include other marine products like prawns, crabs, lobsters, etc., etc., etc. All these things will be covered under fish and fish product. I hope it is clear to all of you. So what if I buy these products? What if I buy these products and go to a shop, go to a mall, shopping mall, and I buy these products from there? Then rule 6DD is not applicable. Rule 6DD is only applicable if you buy these products from the producer of these items. Are you clear? Otherwise, it is not applicable. Then, if you make a payment of retirement benefit to anyone, you can make the payment up to 50,000 in cash. Like if you make a payment of PF, if you make a payment of pension, if you make a payment of gratuity or VRS, you can make the payment up to 50,000 in cash. It is allowed. For retirement benefits, they have given a higher limit up to 50,000 in cash. Okay. Similarly, if you are making payment to your salary to your employee, which employee? Who is going out of your town? If I am making payment of salary to an employee who is going out of town for 15 days or more. For what? For 15 days or more. Or he is going on a ship for 15 days or more. And other than his normal duty place. Suppose he is working in Bombay, so I am shifting him to Delhi for 2 months for some audit work. So I can make payment in cash to that employee, provided I should deduct the TDS as per section 192. Whatever is the eligible TDS, I have to deduct that. So if an employee is going out of town for some official work, and if he is going for 15 days or more, and if he is going for 15 days or more, and if I deduct the TDS, then I can make the payment in cash to the employee. It's okay. Similarly, if I make a payment to a person in a town or a village where there is no banking facility, there is no bank only. So I can make the payment in such town or such village where there is no banking facility in cash. Similarly, where the payment is made by a person to his agent. To his agent, what? Consignment agent. For buying goods or services, okay, I can make the payment in cash. Similarly, an authorized dealer of foreign currency. Payment is made by an authorized dealer of foreign currency. They are allowed to make the payment in cash. Okay, they are allowed to make the payment in cash. Are you clear? And last but not least, payment for purchase of product from cottage industry. You are purchasing the product from where? Cottage industry. And that cottage industry is working without the aid of power. They are working without power. They don't have power also in their business. Okay, I hope it is clear. So if you purchase from such cottage industry where there is no power also, very small cottage industry, labor intensive industry, they don't have machine also, because if there is machine there needs to be power. Okay, it's a labor intensive, they might be stitching something with their hand, etc., something like that. If you purchase from them, it is allowed that you can make the payment in cash. Okay, next, 48.2 and 48.3 interlinking. What if both the sections are applicable in the same question? Suppose I am making payment of 1 lakh rupees in cash to a related party, then both the sections are applicable. Yes, the fair market value is 60,000. I am making 1 lakh rupees in cash to a related party. Then what shall I do? Am I making excess payment? The answer is yes. Am I making more than 10,000 in cash? The answer is yes. Then in that case, you have to follow 48.2 first. First follow 48.2, disallow the excess amount, and then follow 48.3 and see if the balance amount is more than 10,000, then disallow under 48.3. Otherwise, 48.3 will not apply. Let me give you an example. I am making you payment. You are my related party. I am making you payment of 1 lakh rupees in cash. The fair market value is 60,000. First apply 48.2. How much will be disallowed? 40,000 will be disallowed because the excess amount is 40,000. Now what is left now for 48.3? For 48.3, 60,000 is left. Is 60,000 more than 10,000? The answer is yes. So disallow 60,000 under 48.3. I hope it is clear to all of you. Okay. Next section 48.4, which is also related to 48.3 only. Listen carefully how. I am a buyer, you are a seller. We are both entering into a contract. I am entering into a contract with you and I am telling that after 2 months I will buy some goods from you of 2 lakh rupees. So we are entering into a contract, future contract, where I will buy goods of 2 lakh rupees from you after 2 months. And in the contract, we have written a clause, the seller and the buyer has written a clause and they have agreed to this, that I will make the payment in cash. And in the contract, we have written one more clause that if I don't make the payment in cash, you will file a case against me. We have written all these things in the contract. Now after 2 months, I bought the goods and now I made the payment by account pay check. Am I violating the contract? The answer is yes. Am I breaking the contract? The answer is yes. Can you file a case against me? The answer is yes. But this section protects us now. This section says that if any contract says that you should make the payment by other than cash, you should make the payment in cash or bearer check. And if you still make the payment in check, that is account pay check or account pay draft or 4 modes, then nobody in this world can file a case against you. This is what this section protects you. This is what this section protects the spirit of 48.3. I hope it is clear to all of you. So even if it is written in the contract that I will make the payment in cash, even if it is written in the contract that you will file a case against me, still you can break the contract to protect 48.3. You can break the contract to make the payment by check. You can break the contract to make the payment online rather than cash. Nobody can file a case against you. Okay. This is what this section wants to tell us. Next, 48.7. Provision for payment of gratuity is disallowed. So whatever provision you make, that is disallowed. But when you make the payment, that is allowed. Check please. So when you pass a provision entry, outstanding entry, that is disallowed. But when you make a payment entry, that will be allowed as deduction under the income tax law. Okay. Next one, 48.9. Contribution to unrecognized provident fund, that is disallowed. Only recognized provident fund is allowed under section 36 subsection 1 clause 4. If you contribute to unrecognized provident fund, that will be disallowed under the income tax law. Check it please. I hope it is clear to all of you. So after section 40 capital LA, let's move on to section 40 small a, and in this small a there are mostly TDS disallowances and tax disallowances. The first one is 40A1. When you make a payment to a non-resident and if the income of the non-resident is chargeable to tax in India, that is very important. If it is not chargeable to tax in India, then you are not supposed to deduct TDS also. And if you are not supposed to deduct TDS, the question of disallowance does not arise. The question of disallowance only arises if you are making a payment to non-resident and that is chargeable to tax in India, then only you are liable to deduct TDS. So if I am making a payment to a non-resident that is chargeable to tax in India, then I should deduct by when? You should deduct by 31st of March. Deduction has to be made in the same financial year, and then I should make the payment by due date of filing of return. If I fulfill these two conditions, then the expenditure will be disallowed. But if I deduct even 1 day late after 31st March, then the expenditure will be disallowed in the current year, and 100% will be disallowed in case of non-resident in the current year. Or if I deduct on time by 31st of March, but if I make the payment after the due date of filing of return, then also 100% expenditure will be disallowed in the current year. So the condition is you have to deduct on time. Deduct on time means by 31st of March, before the year ends, you have to deduct, and by due date of filing of return, you have to pay. If you violate any of the two conditions, if you deduct late or if you deduct time and if you pay late, then your expenditure will be disallowed in the current year. Sir, is it a permanent disallowance or temporary disallowance? It's a temporary disallowance. Don't worry. You will be allowed the deduction in the current year. In subsequent year, if you will be allowed, whenever you will pay the tax, it will be allowed as deduction in the subsequent year. Don't worry about it. Okay. Now. Sometime what happens when you make the payment to a non-resident, the entire sum of the non-resident is not chargeable to tax in India. Only a proportionate of sum is chargeable to tax in India. Suppose if I'm making a payment of 10 lakh rupees to a non-resident, only say 30, 40, 50% is chargeable to tax in India. Then I should deduct TDS on how much? You should deduct TDS only on the proportionate amount. Who will decide the proportionate amount? Assessing officer will decide the proportionate amount. What shall I do as a payer? You should make an application to the assessing officer. The assessing officer will determine the appropriate portion, will tell you the appropriate portion on which tax is supposed to be deducted, and then accordingly you deduct tax on that much amount. Okay. And if you do not deduct tax on that much amount, only that much amount will be disallowed under the income tax law and not the entire amount. That is what the CBDT has to say. For example, if I'm making a payment of 10 lakh rupees to someone and I know that it is not fully chargeable to tax in India, I should go to assessing officer and ask him to compute the appropriate portion on which tax is deductible. Suppose he said that 6 lakh rupees is the appropriate portion out of 10 lakh. Then I should deduct tax on 6 lakh. If I don't deduct tax on 6 lakh, then 6 lakhs will be disallowed. Entire 10 lakh will not be disallowed. Okay. Now 40A1, after 40A1, 40A1A is exactly similar to 40A1. There are only two differences. First, here you are making payment to resident. And second, here if you don't deduct and don't pay on time, then 30% of the expenditure will be disallowed. And in the subsequent year, when you make the payment to the Government of India of TDS, then that 30% will be allowed to you in the subsequent year. Okay. So this is exactly similar to the previous section. There is no difference between the two. The only difference is this is for resident, that is for non-resident. This is 30% disallowance. There it is 100% disallowance. Rest all is same. You have to deduct by 31st of March and you have to pay by the due date of filing of return. Okay. Now some very important point which is applicable for this section also and the previous section also. Next point which I am saying is applicable for this section also and also for the previous section. That is, listen carefully. Generally what happens? I am a payer, you are a payee. I am a payer, listen carefully. I am a payer, you are a payee. I am paying you a rent of say 1 lakh rupees. I did not deduct the TDS, I did not pay the TDS. So generally if I don't deduct TDS, if I don't pay TDS, then the payer will be considered to be an assessee in default. Okay. And there can be harsh consequences which can be taken against me, including disallowance of the expenditure. Okay. But the Government of India has made one relaxation, and by saying that I will not be treated as assessee in default for not deducting and not paying the tax. Even if I don't deduct the tax, even if I don't pay the tax, I will not be treated as assessee in default if you, that is the payee, has done three things. Which three things? Payee has included that 1 lakh rupees in its income. Payee has paid tax on that 1 lakh rupees. And payee has filed the income tax return. Then it will be deemed that I have deducted, I have paid. If payee does these three things, then it is deemed that the payer has deducted, payer has paid the tax, and on the date on which the payee has filed the income tax return. So on the date on which you have filed the return, on that date it is deemed that I have paid the tax, I have deducted the tax, and I have paid the tax. Okay. I hope you have understood what I am trying to say. Okay. So please try to understand. I have not deducted the tax, I have not paid the tax, but you have done three things. Then it is deemed that I have only deducted, I have only paid on the date on which you have filed the return. Then what all things will happen? In the current year, I have to disallow the expenditure, and in the next year, I will get the deduction of the expenditure. But in the current year, I have to disallow the expenditure because it is deemed that I have deducted on which date? On the date on which you have filed the return, and you will obviously file the return after 31st March only now. So you have obviously deducted in the next year only. So therefore, in the current year, it will be disallowed, and in the next year, it will be allowed as deduction to me. Okay. Plus, will I be liable for some interest? Yes. Only one interest is liable for you. That is 1% per month, part thereof interest. No other interest will be liable on you. Okay. Only one interest you are liable to pay. Coming to the next case, that is the Supreme Court judgment of Palam Gas Service. Very important judgment. This judgment has to say two things. Assessee was saying that Assessee was making two rubbish arguments. First rubbish argument is Assessee was saying that TDS is not applicable to assessee who are following what? Mercantile system. It is only applicable to assessees who are following cash system. So the law said that no, TDS has nothing to do with mercantile or cash system. The court said that whether you are following mercantile system or cash system, it doesn't matter. TDS is applicable to everybody. Okay. This is the first thing which is clarified by Palam Gas Service. What is the second thing which is clarified by Palam Gas Service? That is the most irritating point. That is assessee saying that the amount which is paid during the previous year to the payee, on that, if I have not deducted the TDS, that cannot be disallowed. Only the amount which is payable on 31st March, only the amount which is payable on 31st March, only on that much amount I am supposed to and I am liable to deduct the TDS. The court again said that there is nothing like that. The amount which is paid during the previous year or even the amount which is payable during the previous year, on entire amount you have to deduct the TDS. TDS is applicable on credit or payment whichever is earlier. Therefore, it doesn't matter whether you have paid the amount to the payee or it is payable. Both the cases TDS is supposed to be deducted. So these 2 points are covered in the Palam gas service. Okay, I hope it is clear to all of you. Now the third section 48.3. This is only for non-resident payment when you make a payment to non-resident in respect of salary. So if there is a non-resident to whom you are making the payment of salary, then you have to deduct the TDS. You have to pay the TDS on time. If you don't deduct, if you don't pay, then it will be disallowed under 48.3. And in case of non-resident, we all know that how much it is disallowed. Tell me. 100% will be disallowed in case of non-resident. Are you clear? I hope it is clear to all of you. Okay. Now, some other small disallowances we will see first, and then we will move ahead with the big one, that is 43B, which is very, very, very important for our exam also and for our practical life also. Other disallowances first, 40A clause A subclause 2, income tax, including surcharge and cess disallowed. 48.2A, wealth tax disallowed. 48.2B, if any royalty, service fee, service charge is paid by state government undertaking. Paid by whom? State government, Maharashtra government undertaking to Maharashtra government, then it is disallowed. Plus, if it is exclusively charged on the state government undertaking. Suppose if there is a Maharashtra government which is exclusively charging some royalty, service fee, service charge on the state government undertaking, exclusively on state government undertaking, not on everybody. And if the state government undertaking is paying that service fee, service charge, royalty to the Maharashtra government, then that will be disallowed under the income tax law. Last but not least, 45. If employer is paying non-monetary tax on non-monetary perquisites of the employee, I am an employer, you are my employee, I am paying tax on non-monetary perquisites of your employee, then that expenditure will be disallowed in my hands. It will not be allowed as deduction to me. That tax, whatever I am paying on behalf of you, that will be disallowed in my hands. Okay, I hope it is clear to all of you. Now coming to the big one, that is the most important one, 43B. Certain deductions are allowed on actual payment. Which deductions? Tax, duty, cess and fee. It is allowed only on what basis? Actual payment. You have to pay and then you have to claim the deduction. Otherwise it is not allowed. Which tax? Income tax. Income tax is not allowed only. It is only talking about those expenses which are otherwise allowed somewhere. Yes, you can talk about GST as GST is otherwise allowed. You can talk about municipal taxes paid under section 30, rates and taxes. It is talking about those taxes, duty, cess and fee. It is not talking about those taxes, duty, cess and fee which are not allowed under income tax law. So when I say certain expenses are allowed on actual payment, it has to be otherwise allowed first. Then only you can come and pay and take the deduction. Okay. So income tax cannot be claimed as a deduction by making the payment of income tax. No, that is otherwise only disallowed. So something which is otherwise allowed, come over here, claim the deduction, you will be allowed. Okay. First is that. Second, employer contribution to provident fund, etc. Acha, you have to make the payment of all these things till when? Till the due date of filing of return. You have till the due date of filing of return, you can make the payment. Employer contribution, you can make the payment till due date of filing of return. What about employees contribution? I have told you earlier, employees contribution, there is a stricter time limit. You have to pay by 15th of the following month. Are you clear or not? Employee contribution, you have to make the payment by 15th of the following month. You don't have time till the due date of filing of return. Are you clear? Third, bonus and commission to employees, make the payment, take the deduction. Fourth, interest from public financial institution, interest on loan or borrowing from public financial institution, state financial corporation or scheduled bank or cooperative bank or certain notified NBFCs. All are Indian banks. All are Indian. If you take a loan from a foreign bank, then interest is allowed on accrual basis. If you take a loan from Indian banks, it is allowed on payment basis. Are you clear? Leave salary, allowed on payment basis. And then if you make any payment to Indian Railways, if you take services of Indian Railway, then deduction are allowed on payment basis, not on accrual basis. And last point I will explain after some time. Okay, first let me explain the first 6 points. For the first 6 points, A, B, C, D, E, F. For the first 6 points, you have to make the payment till the due date of filing of return. You have time till the due date of filing of return, pay till the due date of filing of return. If you don't pay till the due date of filing of return, then the expenditure is disallowed. Then is it permanently disallowed? No. This is also a temporary disallowance. It will be disallowed in the current year, but it will be allowed in the year in which you actually make the payment. So in the subsequent year, if you actually make the payment, it will be allowed as reduction to you in the subsequent year. Don't worry about it. Okay. Now, I have to make some payment to the state government for taxes. Now, instead of making the payment towards the taxes, I am giving a bank guarantee. Whether that will be allowed as deduction? The answer is no. Giving a bank guarantee does not amount to actual payment. You have to actually pay to the government, then only it is allowed. Otherwise, it is not allowed. Okay. Next point. Employer contribution you have to pay as per 43B, but employees contribution I have told you multiple times you have to pay by 15th of the following month. Next one, very important point. Fourth point and the fifth point, very important point. I have taken a loan from the bank and there is an outstanding interest. Now I am converting that outstanding interest into a new loan, or I am converting that outstanding interest into a debenture, or I am converting that outstanding interest into a new instrument, or I am converting that outstanding interest into a new bond. Whether conversion of outstanding interest into a new loan or debenture or instrument or bond, whether that amount to actual payment, the answer is no. It will not amount to actual payment. But whenever that converted loan will be repaid to the bank, that will be allowed as reduction. For example, there is an outstanding interest of 10 lakh rupees. Now I am converting that 10 lakh interest into what? New loan. On conversion, you will not get deduction. But when you repay that 10 lakh rupees new loan to the bank, at that point of time, we will give you the deduction as per this point number 5. I hope it is clear to all of you. Is it clear? Now the next point is a Supreme Court judgment of Sassoon Chemicals. We all know that bonus and commission to employees are allowed on payment basis. Now what happened, there was some dispute between the company and the employees regarding the bonus. So the case was going on in the court. So till the time the case was going on the court, I did what? I made a trust and I deposited the money of bonus and commission, the tentative amount that I have to pay, the tentative bonus and commission amount I've deposited in a separate trust. And before the due date of filing of return, the matter was solved, the court order was passed. And before the due date of filing of return, I removed that money from the trust and paid to the employees. Will the deduction will be allowed? The answer is yes. The assessing officer was saying, no, because you have transferred the money first to a trust and then you are making the payment to the employee, I will not allow you. It is nothing like that. You have done everything before the due date of filing of return, therefore it should be allowed. Whether it is directly paid or indirectly paid through a trust, it doesn't matter under the income tax law. Okay, this is what the Supreme Court has to say. They have already asked this particular question in May 2024. Now, last but not least, if you make any payment to MSME, that is micro or small enterprise. If you make any payment to micro or small enterprise, then it is covered in 43B. Now, but in this case, you don't have to make the payment till due date of filing of return. No. In case of micro and small enterprise, you don't have time to pay till due date of filing of return. In case of micro and small enterprise, you have to make the payment by the due date mentioned under MSME Act. First of all, we need to understand what do I mean by micro and small enterprise. A micro enterprise is an enterprise who fulfills two conditions. That is, whose investment in plant and machinery is up to 1 crore and whose turnover is up to 5 crore. If both the conditions are fulfilled, then the entity is a micro enterprise. What is a small enterprise? If the investment in plant and machinery is up to 10 crore and the second condition also should be fulfilled. And if the turnover is up to 50 crore, then the assessee will be called as what? Small enterprise. First of all, we need to identify what is micro and what is small. So we have done that. Now we need to find out what is the due date as per MSME. So if there is an agreement between the buyer and the seller, then the maximum days in which you have to pay is 45 days. If there is an agreement between buyer and seller, you have to pay maximum in 45 days. If the agreement says you have to pay 30 days, then pay in 30 days. If the agreement says you have to pay 70 days, then maximum 45 days. It cannot be more than 45 days. So 45 days or agreed period, whichever is earlier. Understood? 45 days or agreed period, whichever is earlier, you have to make the payment as per that date. If there is no agreement between buyer and seller regarding the payment, that by when the payment has to be made, then it has to be paid within 15 days from the purchase. So the day on which you have purchased, the day on which the transaction has happened, within 15 days you have to pay. That is the due date as per MSME. Now the law says very clearly, if you pay the amount to the micro and small enterprise as per MSME due date, if you pay within the due date, we will allow you the deduction on accrual basis. We will allow you the deduction on accrual basis. You will get the deduction in 24-25. But if you make the payment after the due date, then the deduction will be allowed on payment basis. Then it will not be allowed on accrual basis. So if you pay as per the MSME due date, the deduction will be allowed on accrual basis. If you make the payment after the MSME due date, then the deduction will be allowed on what? Payment basis. This is what this provision has to say. I hope it is clear to all of you. Now let's go ahead with the next part, that is small part, that is deemed income. In deemed income, there are two sections which we need to address over here. One is 41.1, another is 41.4. 41.1 is very important, 41.4 is also important, but 41.1 is more important. Now, if you have taken any deduction earlier of any loss or expenditure, and if you have claimed a refund later on, okay, then you have to pay tax on that. First of all, you have claimed a deduction and now you are getting a refund, you have to pay tax on that. Or if there is any remission or cessation of a trading liability. Trading liability means you have taken a working capital loan and now that loan is waived off by the bank, then that will be considered as a remission or cessation of a trading liability. You have to pay tax on that. As simple as that. Similarly, there are a few examples which I put over here. Refund of indirect tax like GST, VAT. First you took the deduction of GST, now you are getting a refund of GST. So first took the deduction of GST, now taking a refund of GST, that will be deemed income under 41.1. Similarly, SID destroyed by fire allowed as trading loss. First you claim there is a stock in trade in your business which got lost because of the fire. So you took the deduction and now later on you are receiving compensation of insurance. So it is a deemed income. As simple as that, tit for tat. Similarly, remission of unilateral act is also deemed income. Unilateral act means I am a buyer, you are a seller. I bought goods of 1 lakh rupees from you and you sold goods of 1 lakh rupees to me. Now I am saying that I am not going to pay you. You are saying that I will receive from you. So it is a unilateral act from my side that I said that I am not going to pay you. But you said that you will receive. So in that case, it will be deemed income in my hand, because even if I unilaterally write off irrespective of what the seller has to do, if the buyer writes off, then also it is deemed to be income. I hope it is clear to all of you. Okay. So what is the treatment of waiver of loan? Let's see. If the loan is waived by government, loan is waived by whom? Government. Then we have already seen it is income under section 224(18). Do you remember? Income includes subsidy, grant, reimbursement, waiver by central government, state government, body, agency, authority in the chapter of depreciation. So if the loan is waived by government, then it is income by default. What about if the loan is waived by others? It is not waived by government, etc. It is waived by, say, ICICI Bank. Then you need to check the nature of the loan. If there is a working capital loan, then it is a trading liability. Then the principal part, it is waived, then it is a remission of a trading liability, it is taxable. And interest part is not taxable, because interest part was not allowed as deduction earlier because it was outstanding. Interest is allowed on payment basis. So interest portion will not be allowed as deduction, but principal portion will be allowed as deduction, will be considered as income. So in case of working capital loan which is waived off by, say, bank, very important adjustment. Now this adjustment they have asked so many times in the examination. Working capital loan waived off by the bank. Principal portion deemed income because it is a remission of a trading liability. It will come over here. But interest portion will not be chargeable as income because interest was not allowed as a deduction earlier. What if I take a loan from bank for capital purpose, for fixed asset? Then that is not taxable if it is waived by the bank. Okay. Loan taken from a bank for fixed asset purpose, that is not taxable. Are you clear? I hope it is clear to all of you. Let's come to 41.4. What is 41.4? Recovery of bad debts. You have taken a deduction of bad debts earlier. Now you are recovering that bad debts. Then it is taxable as business income irrespective of whether the business exists or not. It doesn't matter. If the business exists, then also it is taxable. If the business is closed, after the business is closed, you are receiving something as a recovery of bad debts, then also it is taxable. I hope it is clear. And last but not least, if the deduction was claimed by predecessor, that is amalgamating company, and recovery is done by successor, then it is not taxable as per the PK Kamal Supreme Court judgment. Check it, please. So these are the two deemed incomes which we have done so far, and along with that we have done three deemed incomes earlier also. Let me show you. 41.2 we have done balancing charge. 41.3 in case of scientific research asset, if you sell the asset without using for business. 41.4a transfer to reserve wala section, if you remember. And 41.5 we are going to do later on in the chapter of set off and carry forward. So entire deemed income picture on one page, you will get it, what we have done, what we are going to do, and what we are doing, past, present, future, everything on one page. Okay, I hope it is clear to all of you. Okay, now some last few provisions. Miscellaneous part, one small section is there, 14a. What is this section all about? If you incur any expense, for an income which is exempt under section 10, then that expenditure will not be allowed. So I am incurring and I have taken a loan for the purpose of earning an exempt income, then that interest will not be allowed to you. Now how will we determine that how much expenditure is incurred for a income which is exempt under this act? For that the government has given one rule, rule 8D. Rule 8D will tell us, see, now there can be two types of loan which I can take in the balance sheet. One loan I have taken specifically for earning an exempt income. Suppose I took a loan of 10 lakh rupees for investing in tax-free bonds. Now I know that this interest is definitely for what? This loan is definitely for tax-free income. So that will be directly disallowed under the income tax law. There is no second thought, there is no if and no but for this particular item. Okay. So if the expense is specifically for that income, then that will be directly disallowed. What about if the expense is not specifically for that income? Suppose if I have taken a general loan of 10 lakh rupees. Now some portion of that loan has gone in tax-free income, some portion has gone in fixed asset, some portion has gone in cash and bank account, some portion has gone in debtor, some portion in stock. Then how to disallow? For that the government has given a fictional mechanism. In point number 2. This is a fictional mechanism. What is the fictional mechanism, sir, here? You have to do what? An exercise. What I am trying to say. You have to take 12 months data. 12 months data. You need to take 12 months average. Which average? 1st April, 30th April, 1st June, 30th June, 1st May, 31st May, 1st July, 31st July, 1st August, 31st August. Like that, I want 12 months data. Which data? Of exempt investment, from which you get exempt income. And take the monthly average of all of them. Monthly average of 12 items. 1st April, 30th April, monthly average of exempt investment, divide by 2. Like that, I want 12 average of 12 months. Then add all the monthly averages, total them. And then whatever total will come, divide by 12. That will give me annual average. And then I will take 1% of that. That is the fictional mechanism which is said over here. See, 1% of the annual average of the monthly average of opening and closing balances of exempt investments. So first you will take exempt investments, opening and closing balances average every month. Then you will total all of them, divide by 12. then you will take annual average 1%. I hope it is clear to all of you. Is it clear? I hope it is clear to all of you. Okay. Now, there are two issues over here which we need to address one by one. First, I have taken a loan in the current year, but I have not earned exempt income in the current year. I will earn exempt income in the next year. Will the expenditure be still disallowed? The answer is yes. There is no need to earn exempt income in the current year. Even if the exempt income is earned in the subsequent year, but to the extent you know that this loan is for what? Exempt income, that expenditure will be disallowed irrespective of whether the income is earned in the current year or not. It doesn't matter. Okay. This is the first thing. Second, I have taken a loan for earning an income which is not exempt under section 10, but which is deductible under chapter 6A in the form of profit linked deductions. Whether that will also be disallowed. I have taken a loan for earning an income which is deductible under chapter 6A. Whether that expenditure will also be disallowed? The answer is no. 14A is only applicable for incomes which are exempt under section 10. 14A is not applicable for incomes which are deductible under chapter 6A. I hope it is clear to all of you. Okay. So these are some very, very technical issues which are there, which comes in the exam a lot of times. So pay attention on that very carefully. Next, again, a very small section, 43D. Interest income on bad and doubtful debts. Suppose I'm a bank, I have given you a loan. This section is applicable to public financial institutions, state financial corporation, state industrial investment corporation, scheduled bank, cooperative bank. In short, to money lending institutions. So I'm a bank. I'm giving you a loan of 10,000 crores. Out of say 1,000 crore rupees is provision for bad debts. So when will I pay tax on interest of that 1,000 crore? Try to understand the point. 10,000 crore is the loan given. Out of that 1,000 crore is provision for bad debts. I'm not sure whether I will receive or not that money, but when will I pay tax on that interest on that 1,000 crore rupees provision for bad debts? So the law has given you relaxation. You can pay the tax in the year in which you recover the interest or in the year in which you credit to books of accounts, whichever is earlier. Okay. Whenever you will recover from the customer or whenever you will credit in the books of account, whichever is earlier, at that point of time, you can pay tax on that. I hope it is clear to all of you. Is it clear? Now, some procedural section like maintenance of books of accounts. If you're following business and professions, then obviously you have to maintain a lot of books of accounts, you have to conduct tax audit and all these things you have to fulfill. Okay, so let's talk about books of accounts first. 44AA, maintenance of books of accounts. For the purpose of books of accounts, all the assessees are categorized into two categories. Certain specified professions are there and others are there. In others, all business assets will come and all other non-specified professions will come. So who comes under specified profession? Let's see. Medical, legal, accountancy, film artist, technical consultancy, engineering, architectural, interior decoration, company secretary, IT professional, authorized representative. These 11 people will come under specified profession. If you are any of the 11 people, then your limit is given here. If you are any other person, then your limit is given over here. So for specified profession, what is the limit? In that also you need to check whether you are existing or new. If you are existing, and if your gross receipt is greater than 1.5 lakhs in all the last 3 preceding years. So if you are an existing chartered accountant, lawyer, medical, film artist, technical consultancy, you have to check the gross receipt of the last 3 years. All the 3 years, it has to be greater than 1.5 lakhs. Even if for one of the 3 years, it is less than 1.5 lakhs, you are not supposed to maintain the books of accounts. Okay. Then if you are a new chartered accountant, new lawyer, new doctor, new film artist, new interior decorator, new company secretary, then you need to check that the gross receipt exceeds 1.5 lakhs in the current year or not. Okay. I hope it is clear to all of you. Is it clear? Plus, you have to maintain the books of account for how many years? For 6 years from the end of the relevant day. Why? So suppose the previous year 24-25 is going on, assessment year 25-26 is going on. So from 25-26 onward, 6 years will complete on 31st March 2032. So you have to maintain till 2032. I hope it is clear to all of you. Now, what about others? For others, the limit is very simple, not so strict. In that, there are two limits. For individual HUF, the limit is higher. For company, firm, others, the limit is lower. Again, here there are two categories: business, existing business and new. If you are an existing business and if your PGBP exceeds in any of the 3, not all the 3, in any of the 3 last 3 years, 1,20,000 or 2,50,000 as the case may be, you are liable to maintain the books of account. Now don't check the second point also, because there is an or in between. You don't have to fulfill both the conditions. You have to fulfill one of the 2 conditions. If your PGBP exceeds what? Check here. If your PGBP in any of the 3 years exceeds 1,20,000 or 2 lakh, maintain the, don't check the second limit. Acha, if the first condition is not fulfilled, then you check the second one. If the turnover in any of the last 3 years exceed 10 lakh or 25 lakhs, you have to maintain the books of accounts. Okay. So either you have to fulfill the PGBP criteria or you have to fulfill the turnover criteria. Don't have to fulfill all the criteria, both the criteria. That too you have to fulfill in only one of the 3 years. Unlike the specified profession, you have to fulfill for all the 3 years. Okay. I hope it is clear to all of you. What about for new people? For new people also the limit is same only. Okay. Now, if you are liable to maintain books of accounts and if you don't maintain the books of accounts, what is the penalty? The penalty is 25,000 rupees. Okay. How much? 25,000 rupees penalty will be imposed on you. I hope it is clear to all of you. Now let's talk about the next section, which is very important section for us academically as well as practically, and it is also important in the chapter of tax audit. Tax audit is a separate chapter which we will do later on. That is 44AB. Who is liable for tax audit? If you are doing business and if your turnover is more than 1 crore, then you are liable to do tax audit. Okay. But for some businesses, the government has increased the limit to 10 crore. Who are those lucky people? Who are those fortunate people? If they fulfill two conditions, then up to 10 crore, no need to do any audit. Who are those people? If your cash receipt is up to 5% of total receipt and both the conditions have to be fulfilled. And if your cash payment is up to 5% of total payment. Now when I say total receipt will include everything, not turnover. This is not 5% of turnover. This is 5% of total receipt. Suppose if you sell some fixed asset and if you receive that money, that is also total receipt. It is not 5% of turnover. Be very careful with this. Cash receipt up to 5% of total receipt and cash payment is also up to 5% of total payment. Then there is no need to do what? There is no need to do audit up to 10 crore rupees. Now cash will also include bearer check and cross check. Because it is written check or draft which is not account pay is treated as cash. So a bearer check will also be treated as cash. A normal cross check will also be treated as cash. The check has to be an account pay check or account pay draft or ECS or such other electronic mode. Okay, I hope it is clear to all of you. Okay. So for business there are two limits, 1 crore and 10 crore. For profession there is only one limit, 50 lakhs. Okay. Only 50 lakhs. And for 4480 SSC we will talk about in the next section. Don't worry about it. Now, what is the due date for filing the tax audit report? It is 1 month prior to the due date of filing of return. Whatever is your due date of filing of return, 1 month before that you have to file the tax audit report. Okay. What is the penalty for not filing the tax audit report? The penalty is 0.5% of the turnover or 1,50,000, whichever is lower. Whichever is lower. It is not whichever is higher. 0.5% of the turnover or 1,50,000, whichever is lower it is. Okay. I hope it is clear. Now there is one small section that I will deal with you all and then we will go ahead with the most important section, that is 44AD, ADA and AE. 43CB, which talks about construction contract, and 43CB also talks about contract for providing service contract. So in case of construction contract, when will you recognize your income? Any revenue or cost associated with construction contract shall be recognized as per percentage of completion method. Which method you will follow? Percentage of completion method. Are you clear? I hope it is clear. So if you are doing what? If you are doing construction contract, you will follow POCM, percentage of completion method. Now what about if I am following service contract? Then if the duration of the contract is up to 90 days, if the duration of the contract is up to 90 days, then percentage of completion method. If contract involves indeterminate number of acts over a specified period of time, it means there is a multiple service. This is not a one-time service. It's a continuous service which you are going to provide. Then straight line method over period. Okay. And otherwise you are going to follow percentage of completion method. Are you clear? I hope it is clear to all of you. Now what does contract revenue includes? When I say contract revenue, what does contract revenue will include? Retention money also. Okay. Retention money will also be part of contract revenue, and contract cost shall not be reduced by any incidental income in the nature of interest, dividend or capital gains. Okay. I hope it is clear to all of you. Now, one last part of this chapter, that is presumptive income. Let's talk about the first presumptive income, that is 44AD. 44AD is applicable to whom? It is applicable to resident individual HUF or resident partnership firm, not LLP. 44AD is not eligible for LLP. And you should be engaged in business. Which business? Any business except 44AE, that truck wala business, that goods carriage business. Apart from goods carriage business, you should be engaged in any other business. Don't engage in goods carriage business, because for that we have already made a separate 44AE section. Now what is the limit for 44AD? That is the most important point for us. Your turnover should be up to 2 crore. But for some people, the government has increased the turnover up to 3 crore. Who are those fortunate people? If your cash receipt is up to 5% of your total turnover. Now here it is total turnover, it is not total receipt. In 44AB it is total receipt. 44AD it is total turnover. There is a difference between turnover and receipts. Receipt will include all kind of receipts. Turnover will only include sales. Are you clear or not? So by default, what is the turnover limit for you? It is 2 crore in 44AD. But if your cash receipt is up to 5% of total turnover, then you can enjoy 44AD up to 3 crore also. I hope it is clear to all of you. What is your deemed income? Deemed income is 8% of turnover. But if your cash, if you fulfill two conditions, then you can enjoy 6% also. Which two conditions? If you have received the money from the customer till the due date of filing of return, condition number 1. And if you have received the money from the customer by 4 modes. If you have received the money from the customer till the due date of filing of return, it should not be outstanding first of all, and it should be received by 4 modes. If you fulfill these two conditions, then it is what? It is what? It is not subject to what? 8%, it is subject to 6%. I hope it is clear to all of you. Now this section overrides section 28 to 43C. It overrides the entire PGBP income. What is the implication of that? That I'll explain you in a while. Now this section is not applicable to certain people. Who? If you are following 10AA, then this section is not applicable. If you are following profit link deduction, then this section is not applicable. Any assessee claiming profit link deduction under 10AA or chapter 6A, not applicable. Further, if you are following any profession, for profession this section is not applicable. This section is not applicable. Assessee engage in commission business or brokerage business. This section is not applicable to assessee engage in agency business. Not applicable because for these businesses the margin is very high. It is not 8 or 6%. It is much higher than 8 and 6%. I hope it is clear. Now, 44AD overrides section 28 to 44. Because it overrides section 28 to 44, no PGBP disallowance will be applicable. No PGBP deductions will be applicable. The WDV of the asset will be computed normally the way we compute for normal assessee. You will compute the same way. The provision of 44AD overrides section 28 to 44C. 43. Therefore, only PGBP application provisions will not apply. Chapter 6A provisions will definitely apply. UAD will not apply because again UAD comes under what? 28 to 44. UAD again comes under 28 to 44 because UAD is allowed under section 32 subsection 2. Therefore, UAD will not be allowed. What about business loss? Business loss will be allowed because business loss is not covered under 28 to 44. This section only overrides 28 to 44. It does not override the entire income tax law. What about if I'm a partnership firm and if I'm paying remuneration and interest to the partners? Will that remuneration and interest will be allowed? Not allowed under this section, not allowed under next section also, but allowed under 44AE. Be very careful. I'm just doing interlinking of 3 sections. Not allowed under 44AD, not allowed under 44ADA also, but allowed under 44AE. I hope it is clear to all of you. 7th point I'll speak in a while. How many times advance tax I am supposed to pay? This section only once, next section also only once, but the section after that you have to pay 4 times. In 44AE you have to pay advance tax 4 times, but in these 2 sections you have to pay only once advance tax. I hope it is clear to all of you. And then this dangerous provision, which is applicable here, and one more time it will come under 115 BBF later on in the chapter of MAD. 2 times this dangerous provision comes. What is this dangerous provision? Which says that once you follow 44AD for 1 year, then you have to follow 44AD for the next 5 years. Once you follow 44AD for 1 year, then you have to follow 44AD for the next 5 years. Now in between, if you say that after 2 years you say that I don't want to follow 44AD, then you can go out of 44AD, but for next another 5 years we will not allow you to come to 44AD, and then you have to maintain books of account for the next 5 years and you have to conduct tax audit for the 5 years. I hope it is clear to all of you. This is what this dangerous provision is all about. Let's move on to the next section, that is 44ADA. This is for certain specified professions which are mentioned under 44AA subsection 1. Those 11 professions were there now. This section is only applicable to those 11 professions. What is the turnover over here? The turnover should be up to 50 lakhs. Here also the government has increased the turnover limit to 75 lakhs if their cash receipt does not exceed 5% of their gross receipts. If their cash receipt is more than 5% of gross receipt, then the turnover limit will be 50 lakhs. If the cash receipt is up to 5% of gross receipt, then you can enjoy this section up to 75 lakhs. What is the deemed income here? The deemed income is 50%. It is applicable to which assessee? It is applicable to resident individual and resident firm. It is not applicable to HUF also. It is not applicable to LLP obviously. This section is not even applicable to HUF also. The rest all sections, all provisions are same only like the previous section. I have written everything in the bracket, what is same, what is different. Okay. You don't have to follow that again and again. Sir, what about 5 years restriction is there yet? No. Here there is no restriction of 5 years. 5 year restriction is only there in 2 sections under the entire income tax law. One is 44AD, one is 115 BBF. Rest all provisions are same only. All PGBP deductions not allowed or PGBP disallowances not allowed. Chapter 6 allowed, business loss allowed, UAD not allowed, advance tax once in a financial year by 15th of March. And one last section of what? Of PGBP. That is section 44AE, which talks about assessee engage in goods carriage business. First of all, this section is applicable to every assessee. Every assessee means individual, HUF, firm, AOP, BOI, company, LLP, resident, non-resident, foreign company, Indian company. Everybody is eligible to enjoy this section. The condition is only one, that you should not own more than 10 goods carriage at any time during the previous year. Even for a single moment in the entire year, you should not have more than 10 goods carriage. And if you don't have more than 10 goods carriage, there is one interlinking that I would like to do. If you are that fortunate assessee and if I make you payment for contract under 194C, then 194C is also not applicable to such assessee. If I make a payment to such assessee, then 194C is not applicable if that truck owner gives me a declaration along with the PAN. If you give me a declaration along with the PAN, I am not liable to deduct TDS under 194C. Now what is the deemed income? Deemed income depends upon the weight of the vehicle. If there is a light motor vehicle, deemed income is different. If there is a heavy motor vehicle, deemed income is different. For light motor vehicle means what, sir? What do I mean by light and heavy? Light means if the weight of the vehicle is up to 12,000 kg, it is light. If the weight of the vehicle is more than 12,000 kg, it is heavy. I hope it is clear to all of you. So for light motor vehicle, what is the deemed income? It is 7,500 per month, or for part of the month also it is 7,500. For 1 month it is 7,500. For 1 month and 1 day, it is 7,500 into 2. For part of the month also it is 7,500. For number of months the vehicles are owned by the assessee. And for a heavy vehicle it is 1,000 rupees per ton. So if the weight of the vehicle is 15,000 kg, then it is 15,000 rupees per month or part of the month for number of months the vehicle is owned by the assessee. So if the weight of the vehicle is 17,000 kg, then 17,000 rupees will be the value for per month, part of the month. All other things are same, but some extra points are available over here which are different from 4480A's. Remuneration and interest is allowed to the firm over here if it is paid to the partner as per 40B, which is not allowed in the previous two sections. Plus, in this section, advance tax has to be paid 4 times, not once like the previous section. Plus, even in this section, there is no restriction of 5 years. If you don't want to follow this section, don't follow. Then maintain books of account and conduct tax audit and prove that your profit is lower than your deemed profit, and we will accept your profit. I hope it is clear to all of you. And here we complete the entire PGBP from section 28 to 44. Now I have done one thing for you. All those who are my students from regular or exam oriented batch would know this, that we have done this great amount of interlinking in our books. That is an area of confusion which we are going to resolve here itself. What are the sections in which manufacturing and production is given? It is given in additional depreciation, in-house scientific research and investment-linked deduction, 3 businesses. What are the sections in which company is mentioned under the entire PGBP? It is mentioned under family planning, scientific research, in-house deduction, investment-linked deduction, Adani and Ambani, if you remember, that is the petroleum pipeline and the infrastructure facility, and expenditure on notified skill development. What are the sections where Indian company is mentioned? Preliminary expense, 35D, exploration expense, amalgamation demerger expense, and investment-linked deduction to business. What are the sections where amortization is given? In these section 3619, 35D, 35DD, 35DD, it is 1/5. Then 35E, taxation of mine, it is 1/10. And then telecom license or spectrum fee, it is over the life of the license. What are the deductions where the deduction is based on some percentage? What are the deductions where lock-in period is mentioned? And what are the deductions where new plant and machinery has been mentioned? This is just a bird's eye view of all the multiple provisions which are repeating at multiple places. Okay. So this is the level at which we have made this particular book for you all. So I hope you all have enjoyed this revision video. Very soon I'll be coming up with the next revision video which will be on assessment procedure. Till then, watch this video, enjoy this video, and try to watch this video as many times as you can to memorize this gigantic subject of direct tax. Your comments are my motivation. The more you comment, the more you motivate me, the faster I will be to upload the lectures for you all. So I expect that you guys comment below, and I expect one more thing, that you guys share this video with your friends in South India especially, where students want to learn direct tax in English from me. Okay. So take care all of you. Bye and study well.